All right, so it's a little earlier in the day. I thought we'd look at what's going on right now, because it's really building up here. And I think it's interesting. It's getting interesting. So let's take a look here. So right off the open, you can see we have the market pops down here. We have a sample for the bears who completely failed to hit. And you can see that right off the open, this is something I was pointing out, we had a zero test. And the bears had the chance to defend tension. Now, we saw a similar thing yesterday with the bulls right here, where it crossed over zero and they defended and they were able to move prices up, but tension continued lower. And I think the bears are sort of looking at a similar play where they're trying to push the prices down, hoping to get something to happen. But there's one extra thing I think that's working against them, which was that, just a second. Okay, so there's one thing that's working against them here, which is that the bears got trapped in throughout here, a couple of places, and they all got liquidated right here. And as this popped up, it accelerated up, and I think showed us that the bears got blown out this morning. And this zero test is correlating with a liquidation, a major liquidation. It took out multiple days worth of bears, just wiped them out. So while the bears may want to defend and they got some liquidity here, we could see that they were unable to defend that liquidity. They were really unable to get that position to work out and defend the probabilities. And I think that's what's going on here is really we're seeing a bunching up as the market sloshes over, pressures the bears who had hopes and dreams and some ideas, and it is pushing against them, and we're just sort of bunching up as we collect people on the wrong side of the position. I think that's what looks like it's going on here as this pops over zero and works out. So the next thing that happens is it dips down. We don't get any liquidity by the bulls, and then it pops back up and we get another sample right here. And then right before it, you see we didn't get any, there was volume right there. So this is the one that I'm tracking, and this is unstructured liquidity. I call it unstructured because there is an amount of time between the signals. So if you get the signal of N and then you get the volume that's correlates, and you have some amount of time. Get rid of that. So this time is a little bit higher. So you can see right there, time between the completion of the signal and the start of it. And you can see that the signal right here we had was right there, it crossed under, and there is the volume associated with it. So this was unstructured. So we didn't get it right here in the lows. We ended up getting it right here. What that sort of looks like to me, and this is a good topic to talk about right here, what's going on, is that when you get a signal, it's sort of like an ad on a TV. You get the signal, and the signal needs to be bright and flashy, and it gets lots of people to look at it. So you want the eyeballs to see the signal, and then you convert them, which is the sales speak for you get them to purchase the signal. And this conversion process is how you get signals to generate volume. And it was unstructured because of that time. It's like it took a while to sink in, or to convince the orders, or to execute, or to get the people to show up. There was some time in there, and that seems kind of unstructured. We like efficient markets. And when I say efficient, I mean that when your institution wants to do something, how quickly the institution can get open interest, essentially. How quickly they can convince somebody to take the backside of their position, or how quickly they can obtain open interest from someone who's already created it. If I want to fill a large institutional position right now, efficiency is how good the market is at generating that opportunity for me. It's not about how quickly I can just execute if I'm scared. That's nothing to do with it. It's a business, and so we want to, that's efficient. So this is a sort of a lack of efficiency. Our signal and our volume are not really lined up. So I look at it as a lack of structure. The structure is sort of not amazing. Well, at this point, so were to hear this tells me that the bears failed and the bulls are sort of having a hard time really getting amazing liquidity. Well, it ticks back up and the bears get a position right here. So the bears sort of have these two positions, but it was pretty clear when that popped up, this shot up, that these guys liquidated. They're out. They didn't hold on. And then we got a new group here, which is sort of like the bigger fish, which is you have genuine liquidity. That liquidity gets liquidated into liquidity, and it's sort of, this group of institutions got converted into liquidity for that group. So it's sort of a bigger fish there. And you can see that over time, they were able to hit but unable to impact tension. So we have the bears who have a position that's not really working. They're failing to impact tension, and they're trying to, I think they're hoping to play this like the bulls did, where the bulls were able to push this up without impacting tension. But I think the bulls had an entirely different scenario yesterday, and the bears don't have that scenario today. I do not think that this is the same thing we're looking at yesterday, just on the other side. It's not. So they're failing to impact this. Well, it moves down. You can see right here, we had an aggressive move down in energy, and you can even see it right there. An aggressive move down in the energy in momentum. And here is the volume associated with it. So again, the signal and the volume didn't quite line up there. A little closer, a little bit better, but they didn't quite. This volume right here doesn't line up. It was this one. So we have the bulls here who hit. You see the sweep up, and it went up. It was a little unstructured. Then the bulls here who took a little time to really have an impact, and they did hit here. So we've got bulls, and then it dips down, and we're getting what looks like teeth. And of course, teeth is where you have a good quality position that runs down and looks for the stops before moving on. And it's because it's the secondary position. It's the second position. And that's what it looks like. So we dip down. You could see there is a multi-day decay retest that shows up really off of this low. And this was really tough because it sort of stair-stepped us down, and then the volume that ended up happening here. So you get this retest, and then this one right here is really the one that I was watching, that we were watching here. And the volume, again, it just was really unstructured. So we're seeing this theme that's showing up for the bulls, which is that the bulls are able to get the liquidity, they're able to get the positions that they want, but it's sort of, they're struggling to do it. And I think that isn't necessarily showing the weakness in the bulls. It's just showing that there's some difficulty in getting people to hold on to the backside of your trade. Not necessarily a bad thing, but it's a characteristic that we need to note. Okay, so at this point, you could tell that this is essentially the lowest position, and it's a risk reduction. And I think it's clear that the bulls have wanted to participate. So the risk reduction is good. The bulls could get sampled here, but it was up near, I think this was like 80 or so, so it would be a while before they could get sampled. And so I think that the risk reduction looked pretty good. What is going on here is that the bulls essentially have control of the market. They have velocity, which is pretty good. They have the advanced decline, which is pretty good. They have tension shooting up, which is probably going to close way up here at like 70% or 60% or something like that, where it's just really great. But the prices really aren't moving. And so if you think about that, it's almost like this whole shot up, right? This whole sling up that just launched things up. It's like and almost like it went a little far, and the market's trying to catch up. And so if prices are outrunning the condition, almost like a lag in a moving average or something. And I think the market's sort of like waiting for the numbers to catch up, for the market to take a breath as it shoots up. That's what it looks like to me. The bears kind of gave it a go, It didn't work. We have people who are going to be trapped upside down here. I mean, this position here looks pretty good. I think they were trying to pressure out these, and you could see they didn't really get it. There was a little bit of a blip right here, but they didn't really get this to curl down in any real meaningful way that I can see. So I don't think they liquidated these positions. I think they were trying to pressure them as best they could. And then there was a decay retest and was able to pop it back up. So as soon as it popped up, you can see right here. So we have bears, it pushed down. We have bullish sample, which pressured this low, which is great structure, popping it back up. We have bears here. We have bulls here. We have bulls here. Bears here. Bulls. I'm gonna put it like a question mark because they did hit, but it's not like amazing. This is where they're really sitting, and then we have bears who failed there. So you can see that we're starting to build these positions on the outsides, and these positions are putting pressure on each other, conceptual pressure, and you could see tension is just simply rising. I mean, these guys are. I mean, I put check marks. They're sort of hitting, but really they're failing to impact tension. So the market is making its way towards liquidating these bears, and that will look like acceleration, where the tension accelerates higher as it pushes up. So that's what it's looking like at a top level as we look at these positions and how it's all set up. In terms of what I think could be going on here, you see how this is slowly making its way towards zero? This has sort of a trajectory here that's targeted past the close. It looks like velocity is trying to target the close as good as possible, and then we get sort of a carrot situation where the market converts all this positive velocity as it moves towards zero, prices move up. I think that's the situation it's trying to present to us. But I'm not sure that that's really what's going on here. It looks like we have positions back and forth, and there's this concept in the background that's like this is going to take a little while. We have velocity. It looks like it's not quite sure. Like there's like this lack of conviction. It's a lack of conviction by these participants is the way it's sort of feeling to me. I think the bulls, I mean, they did liquidate this group. They could have hit and pushed this up and liquidated this group and had this continue higher. This group here has put pressure on these guys, and they could push it higher and liquidate them. But I don't know. It's like they're getting stuck on the backside, and this is starting to be reminiscent of this day back here. Right here. Let me mark it out. If you guys were watching back then. This day. And I'll recolor it so you can sort of see how it looks similar. Where the bulls came in and they had this day where they struggled. They struggled to really capture the bears in the market, and then it pushed down, and then we saw bears being successful, basically just holding that bullish position upside down, which just sort of built over time, and then eventually it didn't work for the bears. And it's almost like we're echoing that thing we just did, but I don't think we're in the same situation. So the echo might sound the same, but I don't think it's going to output the same. We're not going to get another blast up higher based on the same concept we had before. If anything, this looks like some weakness in the bullish concept. To be echoing that past position up here, to have this sort of lack of conviction. We're not trapping out much of anybody. Both sides are building up positions back and forth. I'm kind of thinking a move down. We take out this messy, really was a messy risk reduction position. We could liquidate that. Maybe we get a better spot for the bulls to come in before we take a look at what's going to happen next. I'm having a hard time seeing this as really aggressively bullish, even though I think that the bulls are not losing control. I think it's pretty clear that this is going to be up here when it closes, that daily is going to be up here when it closes, that the bulls are not at risk, but they're so not at risk that concerns me. Like what risk is there? If this pushes all the way down to here, there's no risk. Like there's just no risk for the bulls, and that's just shouldn't have that. So I'm having some issues here with this. Like it's bothering me. And that's why I'm making this video, is because I see these positions coming in. We don't have that same sort of clarity that we've been getting the last couple of days, where there's a couple of players and blah, blah, blah. We're getting a lot of back and forth. We're getting this, and this lack of risk is sort of bothering me. And I think the easiest thing for the market to do is to take almost like this. You say, if there's X amount of risk, let's convert this X amount of risk into a counter trend move until that goes to zero. And then at that moment where that risklessness is converted out into a price move, then the bulls can participate. It's like this is the formula that sort of like feels like it's building in my head, that there's not enough risk for the bulls. And so that lack of risk is going to convert into failure by the bulls. I don't like that. I like risk. I like to know what my risk is. I want to know what the problems are going to be. And with tension looking like this, it's just going to keep rising. And that makes me think there's just not a lot of risk. So this is one of the things that's sort of bothering me right now about the way that the market is building itself. I want to see the bulls come in and pick up this, like a position like this. And I want to see them trap a position like that, get them upside down, and do the usual stuff where we move up higher and you liquidate them. That's what markets do. But this is so aggressive. It's like I'm having problems with this. I don't like it. It's bugging me. So I'm sitting back this morning. I've been watching these things develop, and I'm sitting back because it's just bugging me. Tension is moving the way it is, that we have this developing kind of the way it is. What I'd like to see is, I feel like that if, clarity cycles like this, and this is high clarity and this is low, that we're sort of doing this right now. We're coming out of this like trough where that it's not super clear exactly what we're going to be doing. We got through all of our objectives this morning. We took out the bears, and then all the positioning started. I mean, we achieved everything I was looking for right off the open, which was to get tension up to zero. That's what I wanted yesterday. We got it, and now we sort of got through the to-do list. So I feel like we're dipping out of a low in terms of clarity, and we're coming back up, and it seems like clarity to me would probably show up with this blowing out the bullish position before resetting up what the bulls are going to do. And I feel like not feel like, but in my head, like I'm developing this idea that we could convert the guarantee here, the low risk, into better prices for the bulls. That's like the formula that I'm thinking about. John said, too far, too fast without a counterparty. No, I think we had a counterparty all the way up. I think at the open, a lot of their orders filled and they were done. And I think that's a lot of the reason why the market's sort of gone sideways. We dealt with all the major counterparties at the open when tension, because we were rising and tension never curled up until the open. Then obviously it curled up at the open. And so they all got liquidated. All these positions who thought we were done for and coming down, they all got liquidated. And I think the market's looking to reset. And I think that getting this whole thing that's been building for the last couple of days done has put us in sort of a low in terms of clarity. I want to see that clarity start to rise and get to a point where I think it becomes pretty clear what's going on. And we have a lot of counter plays. We've got back and forth, a lot of back and forth by the players. But I'm sitting back. I'm sitting back and I want to wait for clarity to get a little clearer. I think that there's a lot of positions all over the place. I think that we could go pretty much in any direction, and there's going to be somebody to wipe out. And, just as a rule of thumb, whenever you get to whenever you get to a situation where you could liquidate people above and you could liquidate people below, why not just ruin everyone's day? Like, we could take out these guys and these guys and these guys, or we could take out these guys and these guys and probably finish up on these ones here. I mean, might as well just do this. Might as well. I don't think there's a lot of clarity. I think that's the way that I'm leaning right now. And then once we get those things lined up, I could start to say, oh, okay, I see what's going on here. One thing I think that's interesting here is that these bears didn't hit. And if you remember a while ago, we had a situation where the bear would hit premature. They weren't approved. They're the counterparty. Well, they didn't. We didn't have high levels of tension, like up here, like this day, where that they could get a burn off or something like that. We had very low levels of tension. They didn't hit out of place. We didn't see any real lack of, they weren't overly aggressive about this. They did have conceptually something great this morning that they just walked away from. I think is a tell for the bears that they just walked away from a zero test that they could have had. I mean, they could have defended this and brought tension down. Absolutely. And that would have worked away at daily tension. And the next day we could have seen daily tension down. That could have worked. But they just walked away from it. Why would you walk away from it? Why did you do that? And it looks just like a lot of failure. So I don't think that the bears are really gaining a lot of control of the structure of the market. That's important. But it's that overly confident position that the bulls have that's sort of bothering me. I feel like if I buy right now that I don't have any risk. I'm not worried about it. I'm not concerned. I'm not like, oh, these bears could bring this down. I'm not concerned even a little bit about that. And I don't like that. I need to be concerned. My experience tells me that if I'm not concerned, I'm in a bad trade. And that's what this feels like. There's too much confidence behind this bullish position. There's too much obvious surety. There's too many guarantees. And I don't like that. I want more trouble. I want more difficulty. And we do have people here that we can liquidate, which is important. You want to pump tension, you got to liquidate the counterparty. We could totally do this. It's just fine. But why? Why? One of the things I always talk about is how expensive it is to move markets. It costs money. But it seems apparent to me that if nobody does anything, this is going to keep going. So why do all that work? And this is bugging me. I don't like it. So I'm not making bets to the upside right now. I'm still generally bullish because clearly the bulls are going to have lots of control here at the close. But it's that over assertion of the bulls that's bothering me. The overly obvious, this is a no-brainer buy that bugs me. I don't like no-brainers. They just, my experience is they don't work. So I'm waiting for the conflict to rise. So if you want the term that I keep thinking in my head is that. I'm sitting here going, I want more the conflict to rise. I want to see, we had a little bit here where we had some bullish positions that got, this, but that was just teeth. That's pretty common in this situation. So I think a lot of people just said, oh, okay, well, markets sort of do this in a secondary position. So I don't know that that's all that much drama. I'd like to see something more dramatic to bet on. This just doesn't seem dramatic enough. So I'm not doing much right now. And I wanted to make a video to talk about that because I think that it is a market condition that happens where you get to it. I guess you could say this was the victory lap. It's always uncomfortable to trade a victory lap because they stop participating. Maybe that's the term that might suit it the best. So that's what I'm doing. I'd like to see it move down. If we got the market to move down, cause a little bit of drama, maybe excite the bears a little bit more. give them something to trade, something to believe in, to be like, oh, this is so great, before moving the market back up against them. That could be good. There is a real potential that the market just does, the decay retest and this liquidity sort of fold the lows, and we trap out this group and this group. I mean, we have all the pieces and the parts and pieces we need. It could move up, turn them upside down. We could get this this inversion level from this morning, which is off of right. You can see it's almost like 1500, which is great. We could get this up, retest it, and run. Absolutely, totally possible. So it's just that, I don't know, it really bothers me. I want to see more problems for the bulls. You don't get, like there's no free lunches. And it just bothers me to have such low risk there. So that's what I'm waiting for. If I miss a move up, I miss a move up. But I'm just concerned that there's no good reason for the bulls to inject capital and carry extra risk here, because the market's doing it all on its own. So they're just sitting back and not doing much. And that makes me really concerned. The market will want to just sort of dip, and we could, close the gap. You can see a little easier here. We close up the gap. Maybe price in some of this lower volume stuff down here. Do something like that. It has me concerned. And I've been reading the comments here. Yeah, right. Miguel said today's the victory lap for bulls. Yeah. I mean, if you were bullish over the last couple days and today gapped up this morning, you were like, yay. And your hands, when you do a victory, you stick your hands up in the air. So you're not trading because your hands are in the air. So you go, yay. And it's not good to trade when everybody's hands are in the air because they're not trading. So you're all alone. And it can have difficulty. So that's what I'm seeing this morning. And I wanted to point that out because I was posting a lot about the positions that were going on, but I didn't want that to be skewed as like, if I post that because it's significant. Actually, really what it is that I post the things that I'm paying attention to. And this morning I'm paying attention to these positions because I'm trying to build that narrative up so that we can get the story going here again. And so I'm paying attention to all these positions to see how it builds, because how it starts out, how a trend starts, which is on days when no one's watching, trends and stuff start here in the boring ranges. If you have a range that looks like this and it's so lame, and then it does stuff like this, and everybody's like, what was the signal here? Which is just wrong. It's how did the narrative develop through here that made it possible for signals here to work? And that's the huge mistake everyone makes. You think you put a bunch of things on your charts and stuff, and you're like, what was the signal that started? It's how did this build into the narrative that allowed this whole thing to work, that made it function? If you can understand how that they build and how that they grow and how the strength really works, then you can actually understand what a trend is. And I think that's what's going on right here is the market is built. So I was posting because I was trying to track this narrative to get that piece together so that when the, everything lines up, I get it. And I'm right there with it. I can take bets on what's happening. So that's why I was posting about it. And I wanted to make a video and sort of walk through this like uncertainty I think that's going on right now in the markets, and why I think that is making the markets lean a little bit bearish right now. Even though all the numbers are so bullish and everything looks the numbers are just numbers. It just doesn't really matter. It's that we've got this guarantee philosophy in the background that's echoing in everybody's ears, and it's making it so easy to just throw on a position and shut off your brain. And I don't like that. Miguel is asking, if you have time, could you explain the behavior of portfolio orders yesterday's? It seemed very bullish to me when it was happening. Yeah, absolutely. I noticed that, and I actually think you made a comment about it yesterday, and I didn't reply, and I should have. I do think it's interesting. When I I saw this going on. Basically, the thought that immediately went through my head was these institutions are willing to fill at higher and higher prices. And that is, it is demand when you're willing to pay more. That is demand. So they were filling at higher and higher prices. Usually they fill all the way down, and then just, I think what's going on is just cash average for eternity, and then the market pops up, and then you cash average more, and you cash average more, and there's just always cash averaging in these positions. But in this situation, it looked like there was a real scramble for those portfolios to come in and fill at higher, which is very unusual. Let me tell you what could have gone wrong. Maybe I could find one if I scroll back on this chart real fast. It's been a little while since I saw the situation I'm thinking of. That one's not amazing. There's an event that we see that always concerns me. And it usually looks like what we saw. It's been a while since I saw one. So I call it a price probe. We'll just conceptually talk about it since I haven't seen one in a while. And a price probe, to me, what it means is that it's a study in a particular group of people. So if we took portfolio orders, let's say, and let's just say you had the lever, you could control prices. Let's just say you did that, just a thought experiment. And you said to yourself, okay, they're injecting capital just freely. And you said, well, just how high are they willing to go? And so you drive prices up just until you see those portfolio orders stop. Well, at this point, you've obtained the results. And so you stop and you see price just do this. And as soon as it does that, you see some more filling. And you say to yourself, oh, okay, so at price X, whatever that is, these prices here, this condition in the market is how high they're willing to fill. And now you know something. If you believe portfolio orders are the main body of traders or institutional money, you now know where the top is of their filling. And so this always concerns me when you see a price probe. And a price probe looks like this, where the prices are moving up and they're filling. Because it hints to me that the market is just trying to figure out how high they could go. How high can we get this before they stop filling? And then when you see it happen, it dips back down, they start filling again, and a lot of times you see it sort of move up. They stop filling, and then you'll see a larger move down. And the idea is just push up until they stop. And that's the top. And so while this was happening, that went through my head, was like, oh, we might see a price probe. If like through here we had seen the portfolio orders stop and then it went sideways for a second and then dropped back down and then they filled into a dip, I would have said, ooh, that's not looking good to me, because that looks like the price was just moving to find the high, moving to see how high they go. And we didn't get that. What we got was, they filled all day, and then the condition of the day was basically that the bears were getting stuck upside down. And so when you put the portfolio orders on top of that, I was able to filter out the price probe concept, because it looked to me, from where I was, that it was extremely bullish in that the bears were making a horrible decision, and that these guys were like, oh yeah, let's run them out. They made a terrible decision. It just seemed very attractive to them as an investment. So when I did that, I was able to filter out that concept of a price probe, which is go as high as you can until they stop and bring it back down. And that tells you where the high of the market is. And then you see a correction after that. And it's usually a little bit longer of a correction, like a day or something like that, that you'll see out of that type of thing. It has to meet up with the narrative. Otherwise, you might interpret it wrong. So so when you look at this kind of thing, you can say, Okay, I understand what it means. They're filling at higher and higher prices. And the question is, are we probing them, or is that because of demand? And in this instance, I think it's just demand because of the narrative. It wasn't the market just seeing how high it would go. And so today you could think, well, they filled, so you could almost say there's like some sort of a floor here where that was the last place they filled at. So I always think of portfolio orders as like injecting capital into the market. And so there's sort of money sitting right here. I mean, they will fill if this dipped down like that, they would fill all the way down, like they have no problem. But there's sort of like money sitting there. And we could go back and test the last place that the portfolios filled at. And it's a common thing to do. Aside from the little tiny dip orders, let's find a more clear cut one. Here we go. So right through here, we finished up and it moved up out of their position, and then the next day came back down. And I look at this as like a retest of this finishing up. It was a small order and then it took off. And it's common to do when you have portfolios filling and then stopping, that the market a lot of times will move away, come back and retest just the very last spot that they were seen filling at. It's a common thing that I see. And so tentatively in the back of my head, I have been thinking about this, that this was the last place I saw them filling, and that closing the gap could also be a chance for the market to retest the last place the portfolios were. And so if we look at the context of what's going on right now, which I think there's a lack of narrative, there's some conflict, but it's just not amazing to me. The bulls have shown a little weakness and that they're having a hard time structuring that liquidity showing up. The portfolios finished up yesterday. We could lean back down, close the gap, retest that spot, cause a little bit of trouble, wipe out everybody. I mean, a lot of things could line up really well, I think, with the move down. Miguel says, the institutions that are represented by portfolios, do they operate on a longer time frame? Portfolio orders filling yesterday could also mean they expected this to move up. When I think that the portfolio orders represents a group of traders that have two main things. The first thing is the portfolio part. I don't think it's their portfolio. I think that this is managers in a portfolio. They have like an inventory, stuff like that. And that I think what happens is they have all this capital to invest, and they have unlimited funds to do it. So they could endlessly go into debt. So they have like an infinite line of credit to accomplish their goals. Now, obviously, it's probably not infinite, but for the sake of what we're doing, it's infinite. So there's no margin calling this portfolio group. That's not going to happen. And they need to deal with this inventory of capital that needs to get invested. So the second thing is that they care about the future. And it's the apparent future. And this is a little tiny nuance in terms of like the vocabulary, but it's a big difference. When you place bets, we place bets, I place bets. I say, here's what I think's going on. Here's how I think the narrative is. This is what I think's happening. You look for an opportunity, you place a bet, and you go. You're taking on this sort of risk that's just a different type of risk. I think when I say apparent future, I mean they have to calculate and justify their position. So if you can't say, if I think if you were one of the portfolios and you filled, let's say, $1 million worth of capital into an investment, at the end of the day, you're going to have to put down on paper why. And so you need an apparent reason. So let's say I take the best fit line of the last 3 days. Okay, so I could take that. We'll use the least squared model. So we're taking the least squared model, and it's going to be the best fit line. And then you could say it reached 45 degrees and held. And so maybe through this section, essentially let's say this is D. D was greater than or equal to 45 degrees. Therefore, I continue to fill. So they need this simple calculation to justify their position. So it needs to be apparent in that you can't use a hunch. You can't say, well, I saw the bears got in and I thought that was dumb. That's not going to work. You can't say I placed a bet. Don't say those words. So they need these types of calculations to justify their position. So what they're interested in is the way that the market is apparently going. When I say apparent, I mean things that you can calculate. So they use things like DSP, digital signal processing, to get maybe the form here, and they're saying it's projecting and it looks like it's going to be here by tomorrow based on this, and like a couple of calculations, and it needs to be definable on paper so they can. So when I say apparent, and so when you're looking at these portfolios, I think they need to fill that inventory with an apparent reason and in the future. So nobody wants you to say it was flat. They want you to say, well, it looked like it was going to be here. It looked like it was, so it looked like at this point, I thought it was going to be there. At this point, I thought it was going to be there. Okay, so I know that was kind of a lot, but it's important to understand their mentality. We will buy all the way down as long as we have reason to believe that the market could still be here or there or something like that. And that's the group that we're dealing with. And so if you sort of model it that way in your head and you say, well, what kind of people are these? You'd say, well, these are fund managers. This is market funds. This is 401ks. This is that body of people. It's where that people park their cash with lower returns and no risk. And that's who these people are. And we track them, and they basically just fill all the way down. But I mean, a day like this, you could say, well, the demand was happening because they had some reason. I don't know what it is. What matters is that we can see them. So if you look at this, you could see. I mean, they'll start filling a position. They'll just go all the way down, and then the reason they couldn't justify it for some reason, and then they could, and then they filled, and so that's who it is. They're huge. They have inventory. They fill across the board, and they have this way of thinking, which is the apparent future. And that means you can calculate it. They use a lot of calculus. They'll use some regressions, other things. I don't know. So that's who that is. So when you see them filling up like that, I think it's really interesting how they come to that. Yes. And the reason, I know I probably went into that a lot, but like you're saying, Miguel, you said they're obligated to play, but what it comes is that they have to report. And this is where they're different, because their report comes with rules, and they probably have a SOP, standard operating procedures and stuff like that. So they're not just completely free to do whatever they want. And that's one of the big deals here, is that you have this large body of capital that's bound by, if you want to keep your job, you have to follow the rules, because everything you report goes to the investor. The main investors, usually it's the ones who are funding it, the underwriters, the banks. And then you have to report some percentage win or loss. And so you can't just do whatever you want. And what's important here is making money, not making a lot of money. So they're not interested in 20%. No. They're interested in 4% would be just heavenly, because it's billions and billions and billions. So, a lot of times you go down to get a CD, and I think you get, I don't know what it is right now, but I think it's like under 3%. It's 2.8 or something like that. I don't remember. You just got to beat that. And so all they want, just a percentage or something like that. That's who these guys are. And so when I say I think there's cash there, I'm like, I think there's cash there. Like these are some big boys who drop their money, and they're a little bit dumb. I mean, they're not picky. They don't buy dips usually. Sometimes they do, but these are huge positions. So it's sort of a different, that's why I take it as like a background noise. They're definitely not somebody to try and trade with, because you'd have to trade like them, and there's no way. I don't have the funds to do it, and I don't think it's all that profitable anyway. I mean, it is, but it's not. You'd find yourself being like, I'd rather just try to pick the low. So maybe that's some background, hopefully, to understand who those guys are, and why I have them on the charts all the time. I think they're really useful background information. They give you this color in the market, let you know what's going on. Okay, so I mean, look at this. We've got these guys here, we've got these guys here, we've got these guys here. All the bears, there's 3 bearish positions just sitting right up here at the top. If the bulls chose to, they could drive this up. It would mean capital. They'd have to put money in, so they'd have to risk money. I do that because it's a loss, essentially. They put that money in, but they're gaining control of the market. So why? Like, why do it? Like, why? Why invest the money if we're getting control? We are getting control of probabilities. So if the market moves down, we'll just pick this up. We have control of the market, so just pick it up, make 20 quick points with the 100 contracts, and be done. Arif, am I saying that? Arif? I hope I'm saying that right. He says, do you think they are filling with retail money, not theirs? Yes. It's all those invest. I think that this is the portfolio orders are anytime you pick up like a certified deposit at your bank, goes in there. If you have a trading account with money that you're not using, so, you know, trading accounts usually pay a little bit better. That money's going to go in there. If you're picking up a mutual fund, and I don't mean in there like it's but in this group of people, anyone who has to report what they do. Yeah, this is live, Brian. It's a live stream. So they have to report, meaning that there's some investor. For instance, if I bought right now and it moved up and it made money, or I bought and it went down and I lost money, I don't have to tell anybody other than report it on my taxes. But I don't, like, if I make money and I made money in the wrong way, so it's like, no, that was bad. Who punishes me? Nobody. Nobody's gonna punish me. I don't get fired from my job for making mistakes. I don't have a boss, so I don't have to report. There's no risk or pressure coming back at me from the future, having to tell somebody. So I can make decisions that are just whatever. I don't have to worry about that. Oh, hey, well, welcome, Brian. We were discussing this indicator here, which is a yellow one. It's called portfolio orders. It models a large group of people who just fill in the background. So, 10 minutes behind. Well, if you're behind, just catch up and then ask, because then I can respond to questions and it doesn't seem weird. So we're looking at this indicator here, and who these guys are. Their different mentality, because we have sort of a different mentality for that group of people, and they just generally fill in the background. They're not somebody that I trade with, but they're someone that they're a group that I pay attention to give context to the market, stuff like that. Yeah, you can buy them if you want. You can watch them on Zoom. There's a link down below the video that you can get onto the Zoom and just watch them. There's a little bit of lag. The computer over there is a little bit slower, but it's free. So yeah, Eric, you were asking if they fill with retail money. They fill with anyone who wants to invest money but doesn't actually want to do the investing themselves, I think gets lumped into this group of portfolio orders where they're just filling across the whole market, whatever. They'll buy all the way down. They have to report, so they're a little bit mindless in terms of like they'll just do what they have to do. They fill over long periods of time. Sometimes they pick up dips. I mean, you can see that occasionally they'll do little smaller orders. Usually during trends and stuff, you can see that like here's a good example. You know, they filled into the lows, then it moved, and then they picked up a little bit on a dip there, and you know, and then they didn't fill again until it got lower again. So, yeah, background information. Whoa, trading. I think that's German. Is that German? Alex, so I differentiate. So institutions, when I say institutions, I mean liquidity, which is when you get the signal and the volume, right? So we get that signal and the volume. Institutions, I treat as an intelligent trade. And intelligence in this sense means they are, I want to say, they're cunning in that the way that they get in is by tricking the retail market to take the backside of their trade. So they don't just blindly enter the market. So they're cunning in that they use timing, they use deception, they are people, and their reporting is lower. When you hire an institution, in terms of what I mean by an institution, you just care that they make money. You're not gonna, I mean, your rules are gonna be stuff like, okay, you're not allowed to lose all your money. Like there's gonna be risk tolerances, but they're more intelligent in the way that they fill. They're more cunning. They also have objectives, in that they'll get in an institution like this group, we'll get a phone call from somebody up at the top, says, I want to fill a position. Here's where it's at. Make it happen or you're done. And so they will come in and they have to accomplish those objectives often. It's just, that's part of the job. And so sometimes we'll see institutions fill an order. Maybe this was an objective. It's like, well, why did you do that? I had to. So I don't get to know if they're objective based or if they're seeing a good investment. Typically, they're not. Most of the time they're just doing what makes money because that's their job. But occasionally you may see a position that's just an objective. They also are looking for profits. So they're not just getting into the market endlessly for no reason. Like they're saying that. So when I say they're looking for profits, that means, like we saw this, like they were pushing, when the market came up, it liquidated this group here when it popped up. They cover. They get out of the market. Where you have portfolio orders, I don't think they're necessarily looking to just like ride a cash average and take us quick profit. I think they're just investing in the market endlessly, just forever, no problem. And so there's that difference. Also, when I say institutions, you can sort of pinpoint where they are, like you can point at them. Where with the portfolio orders, they're sort of in this area. They're not it's not like, oh, they're right here, or they're at this price, or they're at this price. We just know they're in this area. I don't know what their cash average is because it could be multiple days. They could be years worth of filling. So you can't really point at them. And that's a big distinction too. If I said there's institutions, where's an institution? I'd say, well, right here. I could point at it. But if you said, where are the portfolio orders? I'd say they filled all day yesterday. And so it's a little harder to point at. So that's one of the distinctions I mean. They're both institutions in that they're businesses. But when I say institution, I mean liquidity samples and all the typical stuff. So I don't treat them the same as institutions, is what I mean. Miguel, do you believe that monetary policy such as QE affect intraday moves? So monetary policy. Okay, so The objective of monetary policy, I think, is completely different than what everybody wants it to be. And I think this is one of those things. It's like a bubble. I just saw somebody tweeting out today. They said they were saying the Fangum stocks, the Fang stocks. There's 4 stocks that have all the money. Therefore, it's a bubble. Well, one of the things that's really difficult with that is that it's too obvious to be a bubble. And we know from years and years of financiers talking about bubbles that one of the problems is that you can't know a bubble until it pops. It is the popping. It is the popping that closes the superposition of a bubble. And so monetary policy is kind of like that. You want monetary policy to be something that it cannot fundamentally be. And I think it's one of the problems that I have with monetary policy. I think that if you're the Fed, this is your goal. I think this is their meetings. I really do. They sit down and they'll look at each other across the table and they'll say, if we say we're going to raise rates, what'll happen? Oh, the market will explode. They'd say, okay. What if I just don't say I'm not gonna? What if I just don't say I'm gonna keep rates the same? Like a degree back. Oh, the market will move aggressively. And they say, well, what if I just don't say anything? Oh, the market won't do anything. And they say, oh, well, let's just go to that next one. Their goal is to do as much nothing as possible to get as much action as possible. And I think this is important because it's like a bubble. You can never get what you want. You want the Fed to say this or that. And they should never say this or that. They should always do less than you want. And they should never be clear. They should always be ambiguous. And that's the irritating thing about them. That's what drives me nuts about the Fed. And so a lot of the times I hear people talk about monetary policy, and my position is always the same. It is always the same. I went through I was trying to learn about monetary policy and understanding it, and my conclusion was fairly simple. It doesn't matter. What changes the direction of markets, let's say we have a major trend that looks like this over, and then it turns and goes like this. You'll get monetary policy all the way down, and then it'll go up. And the Fed will come out and say, yeah, well, it just takes time. What they're not telling you is that what moves things is laws. Major pivots on a monthly chart are governed by laws. And what I mean by that is when you go into the bank and you tell the bank that they can no longer offload their debt into different places, their liabilities into maybe the housing market like they were doing before, the bank themselves has this liability, and before they were taking that liability and they were funneling it into, say, housing. Why would you do that? Well, because there's not a lot of competition in housing. It's just you and the other banks. Like, we don't have to deal with the retail market. But then the law comes in and says no. Well, then they're like, okay, well, we have all this. We have to go into the market. And that right there is what changes market direction. Every time. So I think that what's going on here is that we hear about monetary policy over and over and over and over. And then what happens is on the way back up, monetary policy takes credit for it. They want to say, well, yeah, well, it's because of our monetary policy. And really what they're trying to do is just create the highest amount of volatility with the lowest amount of action because that's profitable. And that's it. We know that back in the time of Andrew Jackson, remember that from a history book, he got the national debt down to zero. And he was pissed. He was so mad at the Federal Reserve. And his statement was pretty straightforward and cutting. He said that you guys go out and take bets in the financial markets and you offload your losses onto the public. And he was mad because that was the major driving thing. I think what he meant was, I got rid of all the debt and you guys are the problem. And his thought was, You go out and make the bets, and if you lose, you just offload it onto the public, and if you win, you win. That's great for them. And so I think that the monetary policy is very similar. They're just trying to generate a bunch of volatility based on the fact that they have a massive lever. And if you're afraid of them, then they have power. And they do have power. You can't disrespect the Fed, but the Fed does not absolutely 100% has no effect on major trends. I have never seen it. I don't think it works. And I think it's horse crap. It's just the fact that they can dilute the currency, that they can endlessly pick up securities in the background. But I've never seen it actually effective, ever. Never seen it. So I think what happens is that you're sitting there watching the market and it looks like this, and then you see this and you're like, oh my gosh, what was that? And it's like, what was the Fed? But this here, this amount of pricing, the delta, is equal to the amount of fear that people have of the Fed. That's it. It doesn't have to do with the Fed actually doing anything. It just has to do with how afraid they are. So the Fed will do whatever they have to do to make sure they can acquire a certain amount of volatility out of their actions. And that is it. What you want to watch for is you want to say in major trends, you look at the banks, and this is what you do. They're picking up a bunch of liability. For instance, right now, are they picking up liability? Absolutely. They're probably picking up a whole bunch of homes. I'm just going to guess a lot of people are defaulting on their loans, and the banks probably say things like, well, we don't actually want your home, so what can you pay? And people might say, well, I could pay, I don't know, $500 a month. And they're like, okay, you can stay in your home, pay $500. So, they're getting $500 when they wanted to be, I don't know, pay $1,000. I know that's a terribly low mortgage, but that means they're 50% of their liability. They're 50% liable. So the question is, where are they putting all that excess liability? Where? And I think that's going to answer your question, because the bubble, the last time we saw that was that they took the liability that was coming in and they funneled it into some thing. We'll just call it X. I don't know what it is right now. I've actually had a few conversations about this, and the question is, we have inflationary liability. Trump printed like 12% of the currency or something like that. So there's some inflationary liability that the banks are dealing with. We have a lot of homes coming in. People are defaulting on their home loans and stuff like that. It's coming in. So these two things are slamming banks with liability, and they know it. Where are they putting that liability? That's what's going to change, because if it comes up that they bundled it into something and they hid it somewhere in next year or something, or tomorrow, and then we have some legislator comes out and says, you guys can't do that. Maybe let's say they bundled their liability up and they put it into popsicles. However you spell that. Sickle. It doesn't. They put it into popsicles. I'm going to spell it cycles. I know that's it's an I. Popsicles. They put it into popsicles. And then a legislator comes out and says, our children eat popsicles. That's you monster. And they put their foot down. You can't offload your volatile risk into popsicles. And they put the foot down. All that liability is going to come back on the bank, and the bank's going to go back to the homeowner and say, pay us now. And the homeowner's going to say, I can't do that. So they leave the home and they go out, they're homeless, and they get on social programs. And this is when we get a problem, is that the legislator didn't realize they were going to put this liability flow back into the market, shove all these people out of the home. And that's how we had the last housing crisis. And I think we're looking at another one. These homes are going to get dumped. And then the bank is also going to deal with inflationary problems, which everyone in here should know exactly what that means. This is a typical thing. So this is the thing that changed the trend, not the Fed. It's going to be some legislator who's offended at popsicle sales going through the roof, and they're being debt bundled into the popsicles, and our children are eating them, and it offends my sensibilities. And then it's over. Another trick that I think you really should pay attention to right now is that there's this country called the United States, and we pump out this product called the dollar, and we also pump out this other product called the dollar, but it's not real. It's debt, but it's liability. And the United States loves, well, we froth at the mouth when we can make other countries liable for our crap. We just, it's like, oh my gosh. How do you think Greece went under? Remember when that whole shenanigan? We still have people floating around the world trying to get into countries with dark hair and great stories. It was because we offloaded all of our debt into Greece's country when they were like, we need loans. So they took really high risk variable interest rate loans from the United States. And when the housing market popped, the housing market in the United States didn't get too bad. It recovered pretty well, but Greece's interest rates went through the roof and they defaulted on their loans and their country crashed. And the United States was like, oh, I just love that. I just love it when we can make stupid choices and other people's countries crash. So I think everyone should be looking for where on earth the United States 12% inflation's liability is getting dumped right now because it's piling up. The housing market's is looking crappy. It really doesn't want to pay the price. So what are we like? Sending variable interest rate loans to Canada or so? I don't know where's it going. We're about to take out. If I had to guess, I'd say China, but since I think, the public opinion of China is pretty low right now, so if we screw them over, I think a lot of people would be happy. So I think this is the thing that people need to watch out for. And we're all focused on monetary policy. It's like monetary policy. That's just silly. Like, they can do some things, sure, but I don't think monetary policy is really the thing that's going to be the biggest here. Well, what's going to happen is at some point things are going to break. The other shoe is going to fall. And I think the question isn't how is the United States going to survive? It's who have they made liable? Who's the scapegoat? Because you're nuts if you think financial people are not that smart. You're just absolutely nuts. They're offloading the liability of this whole crisis somewhere. And I don't know where. But we don't ever get a no until the law passes that stops them because somebody's mad about it. You can't do that. You can't take debt and bundle it into every barrel of oil. People put that in their cars. I'm offended. And then they get mad and they make it against the law. And so the banks have to take that liability and reroute it somewhere else. And where do you think Fannie Mae and Freddie Mac came from? It was the whole magic trick. If they do, I feel bad for Japan because if this goes sideways, it's not the United States who's going to get in trouble. It's anyone holding massive U.S. variable interest rate loans. Those are the people who are going to get screwed, not the United States. I think people have that upside down. And I think a lot of countries do this, where that's why you can't have one country just go under. That hurts everyone. So I think it's just that the United States has distributed so much debt. Like, I think it's just funny when people are like, oh my gosh, I don't even know what it is. Let's look it up. I'm going to look it up right now. The debt clock, U.S. debt clock. In real time. Okay, so we're at $26.5 trillion. Here it is, the U.S. debt clock. Yay. I'm not holding that loan. Who's holding that loan? The United States has given that debt out. It's so funny. If this is the U.S., they went and gave interest loans to these guys and 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 everybody else. And they're basically saying, hey, guess what? Our problems are your problems. Either we win or you lose. That's it. The more debt we get, the more control we have. There it is. Magic. Because we gave everybody variable interest rates loans or high interest rate loans or whatever it is. And if we don't default, they do. So I'm just saying. So if you're wanting to figure out what's going to make a difference in this trend, you need to go figure out how the banks are offloading their liabilities, because as far as I can tell right now, they found it. I don't know where it is, But it's pretty clear to me from these charts that the stock market's doing great. We have people just making money hand over fist. Things are just looking great. So where are these stinking banks offloading their risk? I don't know, but when you find it, don't tell the legislators, because if you do, they'll get all offended and pass a law, and that's what will change the direction of the market. It's laws, and then those laws come in because people they hear that there's my mortgage has some random person's debt in it. I'm so upset, and then the laws come through, and that's what caused the housing market crash, because people's sensibilities got thrown for a loop. So that's what I'm waiting for. I've been trying to watch for laws and stuff happening. If you really want to keep an eyeball on it, I like to check this page. I'll show you. The FINRA discipline. This is where it's going to start right here. So this is where the FINRA, they go out and they spank people. It's great. They spank people. Bad institution. And this is where all the stuff starts at. So you can come through here and you can scan through. You can find what did Merrill Lynch do wrong and how much did they have to pay. This is where you're going to see the trouble start. What did Lime Brokerage LLC do wrong over there in New York and how much did they have to pay? This is where the problem is going to surface first, right here in this list of things the FINRA went out and spanked people. And these are the people right here. And they'll take away their licenses. They'll yell at the firms. They'll make everybody pay money back. They could go to court. It's a little dry, but this is where it's going to show up first. If there's something, that's where you're going to get. You go to the FINRA disciplinary stuff, and that's where you're going to see the law start. Somebody's going to see something and be like, "Oh, I can't believe they did that," or it's going to be a constant problem. You keep doing that, and then. So that's what I've been keeping tabs on that, trying to keep track of that, because something's going to happen, and we're going to all of a sudden understand where on earth the banks are offloading their liability, because it's clearly not the stock market. Even though everybody's afraid of that, everybody was shorting for some reason. It was like the popular thing to do. But what they were mistaking was that they thought that banks were not crafty, creative, liability disseminating monsters like they are. That was the mistake. It really was. So Brian says, what do I do daily? Day trade, options, buy, hold, all of those. I am a slow moving creature. I usually I day trade. I shoot for shorter intraday moves, and I track the narrative. So my goal is to say, I know what's going on. And I value that significantly more than I know where to buy and sell. Significantly more. I think it's more important to know what's going on actually in the market, not in the news world, in the financial market. Where are they positioned? What are they doing? How's it working? And then your goal is to take bets based on what's actually happening. And your number one goal. If you win, you know why, and if you lose, you know why. You should never get blown out of a position or make a bunch of money and have no idea what happened. That is the worst. You never want to get away, take a trade, you lose $2,000. You walk away from your computer and you go, I had $2,000 earlier and I don't even know what happened. I don't know who took it. That's the worst. That's the worst situation. You should never be in that. And a lot of people are comfortable with it. They're not day traders because it messes with your psychology too much. So you need to know what's going on so that you can place bets based on the scenarios, the situations going on. So we try to get a really good beat on what's happening, where markets are going. And the golden goose here is this. Institutional intent. This is money. It's one thing to know what they've done. It's another thing entirely to know what they intend to do. Because if you know their intent, then you have the filter that matters. This is the ultimate filter. because then if you see prices dip and then you see some sort of buy signal, then you can know if they intend to buy it. If you see something dip and you know they do not intend to buy it, then you do not act because you know what they're doing. It also helps you understand why things act the way they do. Like, for instance, today's sideways market. Like, why is it this way? Well, it's because we just finished up like a multi-day blow-off, liquidation, where that they wiped out a couple of positions that had built up. They liquidated them. We could see that here. And the market just lost their major bag holder, and it's trying to recoup the narrative and re-get some conflict in the market, where conflict, essentially you have it's people doing things and conflict naturally happens, and conflict is the driver of opportunity. So we're still looking for that conflict to really develop in front of us today. We have some positions that happen in a little bit of conflict that's happened, but the market's working out that narrative. And then once we see the conflict come up, we're going to see the opportunities come in. You get clarity. You're like, oh my gosh, I know what's happening. I see what the institutions are doing. Then you can place a bet, take advantage of it. And your goal is to just, I'm a meat and potatoes trader. So, if the market runs 100 points, I just want 10 or 20. Like, I'm just looking for the meat and potatoes. I think that 100-point move, you can pick off 10 points off a 100-point move, and you can pick that up with higher amount of contracts. I don't like catching 10 points of a 10-point move. That's not meat and potatoes. Like this section here, I should be appreciating the narrative. So you're sitting there going, oh, okay, I caught the 10 points. Then you track the narrative and you see how it develops. And then any opportunities you're able to take advantage of as it continues forward. You shouldn't be looking for signals and trying to execute trades based on statistics, which are, I don't know, I'm just not a fan of statistic signal chasers. John says, just started reading the deficit myth, and a lot of your monetary comments align with the MMT. Oh, good. I haven't read that. Let me know if you find any good like nuggets of truth in there. Mine are just, I used to drive a lot, like a couple hours a day, and I would just meditate on what was going on and just sort of try like work through it. And the Federal Reserve just never made any sense to me. I couldn't find a scenario in my head where the things the Federal Reserve claimed they were doing made any difference. But the legal system seemed to have major laws passed at major turning points. You can go find those things. And it makes perfect sense why the market stopped going up or stopped going down, because you're like, oh, and the general rule of thumb ended up being banks offload liability. And that's how come our market's shooting up, because people are going, oh my gosh, sell, sell, sell. It's like, you're not selling banks breaking the economy. I trade, for me, okay, so Alex said, if you don't trade 10-point moves, where's your last meat and potato trade entry and exit stride? I shoot for 10 points. I think markets think in 10-point moves. I've been trading the ES for 13 years exclusively. I did trade currencies for a couple months. But I liked the ES. I think the market thinks in 10-point moves. They go 10, 20, 50, 100. I don't know. It just seems like it thinks that way. And so I shoot for those 10-point moves because they're nice, easy. They're not easy, but they're square. It's a nice little package deal. I picked up some options. I was talking to Joe about it Monday. I picked up some options on Sunday night. I posted when I was up on Twitter about being bullish When the market dipped down, I was quite confident that the market was bullish. I think everybody in here probably knows that. And when it dipped down on Sunday night, I picked up a couple options and the market opened and I took my money. I was done. I didn't catch, so I didn't hold on through all this. The market opened up here, came down, moved up, and I covered. When it pushed a new high, I was happy. I'd caught some money and I dumped my position. And then I watched the rest of the day. Okay, so I've gone through a couple of phases. When I first started trying to run a room, I had this idea about what I wanted to do. I knew I wanted to do something good. I wanted to do something useful. I wanted a community. First, I started to share narrative, talk about the signals, the samples, and I would go over every single thing that happened over and over and over and over. And I would spend 7 hours a day posting thousands of times a day about exactly what was going on and everything I thought. I think that was useful for a few. Then I moved to, well, the people just want to watch me trade. So I would make videos and do trading. And I learned this really interesting lesson, which is that telling people your trades makes your trade, if not double, almost exponentially heavier on your shoulders because you're carrying their liability. For instance, if I said buy right now, you'll buy, and if you lose money, I'm wrong. So I'm liable. So you get all the money and I get all the pain and suffering. It's heavy and you feel it. Go ahead. Go tell people what you really think and tell them where to buy and sell. And watch how heavy that is on your shoulders. Now, it's not a big deal. I don't have a problem with doing it. I mean, it's a good practice to do. You should practice standing in front of a group and telling them when to buy and sell. Try it. Go ahead. Tell everybody exactly where you're going to get in, what you're going to do, and then you take the trade and watch, or at least assume that a few people will shadow trade you and know that if you're wrong, they lose money, and that whether they say it or not, it's your fault. So you learn that there's this risk that comes along with social. There's a social risk, and it's a real risk. What I learned was that as you tell people exactly what you're going to do, they stop focusing on narrative and they start turning into slugs. They'll do the like. It's like this. It's that, I think it was Dimitri Martin. He was like, depending on how hot you are is how much I care about your cat. You remember that? He's like, if you're really hot, I'll listen to your cat, about how your cat, whatever. And if you're not, then you won't. And I think this is actually, he was joking. If you've never heard this before, it's a total cultural reference. I'm sorry. But it's sort of like the more credible you are, or really it's the more credible you appear to be, the more I'll listen. And the problem is that it's not that you'll listen, it's that you act like you'll listen. And so what I was finding is that the more that I would tell you when I was going to buy, the more you would act like you were listening to me. And then when I checked your comprehension later, traders were not comprehending. And I realized it was because they were essentially being nice to me as long as I told them where the trades were so that I could be liable while they made the money. And I don't want a bunch of sheep. I don't want to deal with your liability. I want you to learn how to read a market so you can be liable and you can check me if I'm wrong and you can give me good ideas and I'll give you good ideas and we'll do a great job. And so I stopped sharing my trades because I think I was actively harming people's ability to understand markets. And it was adding a lot of burden on my shoulders, which I thought I was carrying. I thought I was telling people when I was buying and selling. And I was like, well, I'm willing to carry this extra risk because you guys are listening and you're learning. And eventually you'll get it. But what was happening was I was carrying this and everyone was, not on purpose, lying to my face about listening. So I said, fine, I'm not going to carry this extra risk if it is actively making it hard to listen. And it was the hotness thing. It's like I was talking about my cat and everybody was listening because I had something valuable. So I stopped sharing my trades because I wanted comprehension. And now I'm to the point where I'm realizing that you need a chance to walk on your own. So I go over today I got on a little earlier because I wanted to talk about what was going on in the market, but I go over what's going on in the second half of the day, and then I set up what's going to happen the next day so that you have the chance to watch the indicators on your own and take the risk on your own, because that's what you need to practice, not listening to me. And I'm trying to do what traders need, not what traders want. I don't think it's useful to tell everybody what the next trade is. If I told you when to buy and sell and you happen to take a few contracts and you made $2,000, that makes no difference over the course of the next 2 years about whether you're successful or not. But if I can deny you access to shadow trading me and it can make you a better trader over the next 2 years, I would rather that. So, this is just me just doing give and take and paying attention to what traders are doing and trying to do what is getting the best outcome for the traders. And currently, I think this is the most effective model, is to live stream and talk about what's going on at the close, to give to frame the next morning, and then say very little, and hopefully traders listen and then get up and watch for yourself so you can freaking do it. Because I want a group of people who are useful. I don't want a bunch of freaking sheep. I don't want a subscription model, because if you're going to pay me $50 a month, you think I'm going to be here for every day during the month for your questions? I don't want to do this forever. You want a group of people who are competent, who can give you good feedback, who have good opinions. So on the days when you make a mistake, when I make a mistake, there'll be 4 or 5 other traders who have a good opinion who can correct me. It's social groups who save you from yourself. It is not you. You can't control yourself. You will make stupid choices over and over and over until you realize that it is the group who saves you, not your discipline. Discipline is a silly, silly idea. Discipline is something you do for a while to accomplish some skill, and then you stop with the discipline and you go contribute to the group. Discipline is a myth. You can discipline yourself while you learn, but your discipline needs to stop at some point. You cannot be disciplined your whole life. It's a silly idea. It's groups who save you. It's groups who get you out of bad trades. It is groups who keep you from getting emotional. It is the group who will save you, not you. And so one of the problems you'll run up against is that if you have a leader of a group, in this case me, and I decide to be an idiot for a day, if I don't have any competent traders to check me, then the whole group of sheep follow me down an idiot rabbit hole. And I can't have that. I'm good at this, so it doesn't happen that often. But it's a big deal. You need to have a group. You need to share what you think. You need to, for your sake, not ours. We'll listen as long as the things that you're posting aren't just nonsense. And as long as your objective is to share, not to compete. If you're posting saying, I'm right because you're wrong, whether you're right or you're wrong doesn't really matter. You're an idiot. Nobody's listening to you. People just want to hear contribution. If you post a chart and you say, here's what I see, and I really like this indicator, everyone's going to listen. We assume that if you really like stuff, that there's a reason, and so we'll consider it. So I need competent traders around me, not a bunch of sheep. That's insane. And anyone who doesn't believe that that's important is an amateur or scamming you. They're trying to sell you on a subscription and say, I'm your guru, I am perfect, buy me. And they're wrong. They're lying and they're wrong. or they're selling you some system. Either way, it's a subscription. I'm not interested in subscriptions because I don't want to deal with you. You guys are not like children. I don't want a bunch of children. I want competent people. I want a community. I want to make money trading, not being followed. So this is where I've gotten to for is live streaming what's going on in the afternoons to try and prep everyone for the next day and things like that, and then letting people have the opportunity to do that. And I've seen a lot of traders do a good job, and I think that is very motivating for me. Alex, that's a good point. Sharing does create sharing. And you have to recognize that you need to share. I'll just tell you this right now. You need to share. You need to you don't want to just share charts that justify your position. What you need to learn to do is share your real opinion. Take that risk. Take it. And if you can learn to share your genuine opinion, what's really important is that a group of people will correct you. That's the whole point. Like, that's the point. And you need that. Well, if you have somewhere else to have the conversations, that's great. That's what you need. The whole point is that you will wake up one morning. You'll sit down to your computer. You'll have been doing good for a month. Great trading. Your equity curve looks great. You'll see something, place a trade, it'll go against you. But you know that's a good trade. I mean, you've been doing great for a month. And then before you know it, you lost all the profits you had for the entire month. And then you'll slouch away from your chair and you'll say to yourself, what just happened? Why did I do that? Why? Oh my gosh. And you'll look back and it'll be some tedious thing that wasn't even in your structure. You'll be doing something like it comes down and you see a buy signal and you sold it for some reason because you were so smart. And it turned you upside down and drove you out. Or it'll come down and you'll see like a double bottom. And you don't trade double bottoms, but for some reason you bought it. And it failed. And you're like, oh, well, my double bottom's right. It's just trying to trick me. And it'll come back up and then it'll run you out. And you say, why did I even do that? Why did I do that? And it's always things that are outside your structure. It's always things that are stupid. It's always nonsense. And at the end of the day, you'll ask yourself, how do I stop myself from doing it again? And I will tell you the answer right now. It is a group. You cannot stop yourself from yourself. You will never do it, and it will never happen. You will constantly lose money for stupid reasons over and over. And the market knows it. And after a couple of years of doing this, you'll realize this is what's happening. You make 10 here, you make 5 here. You make 10 here, you make 5 here. Then you lose 30. And you'll say to yourself, oh my gosh, the market just used me like a piggy bank to make the money and then pull it all out at once. And you'll go through that cycle over and over and you'll suddenly realize you're being used so the market can build up enough funds to drive a trend. Holy crap. And you'll hate yourself for doing it. And what you have to realize is that this is not a problem. You are not broken. You are not incompetent. You are not an idiot. This is the market taking advantage of a bunch of people who cannot communicate. They are alone. This is the problem. And once you come to grips with the fact that you need a group, then you'll stop doing this stupid thing. You must share for your sake. Once you learn to share not charts that make you look good, but the charts that say what you think, you'll know because you'll feel the risk, the social risk. Sharing your real opinions is something that takes a little doing. You don't share charts that make you right. You share charts that are about what you actually think. And if people correct you, that is good. That's really good for you because they see something they agree with or disagree with. You need to think about the things they say and accept the fact that they're giving you feedback. I think that differing opinions are wonderful. If I share and you disagree, that's great. That's a good thing because then we're getting somewhere. Where you have a problem is when you share some little thing and you're like, I'm going this way, and then suddenly the entire group is also going that way because of you. This is a problem because it means that everyone has their brains shut off. You don't want that. You want to post something and get different opinions. That helps you see things you didn't see. It helps you broaden. The point is that social risk is really, really important, and it's the thing that stops you from yourself. It is the only way. The only way. I have worked this problem for years. It is the only way. System trading does not work. I think that if you're going to if you're going to automate your trading system, that's fine. You don't need a group. But if you're going to trade discretionary and go for real money, where system trades are incapable of really like turning wealth, making wealth, they can make money. I don't know that they're going to be able to really turn you the type of profits that everyone thinks they want. Discretionary trading is the only way, I think, to really make large amounts of money regularly. I think that automated trading has too many filters to compensate for the fact that you're not playing. Brian, you quit your job to day trade. That's tough. I know some people have done that. It is difficult. I think the biggest issue is that you get too hung up on what money is and not hung up on narrative enough. If you're sitting here looking for the next trade to make some money, that can be a problem. What you need to be doing is focused on the narrative. What's happening? What's going on? Why are they doing this? Where are they headed? What's happening? And then what you need to do is learn to obey yourself, not the market, not what the charts say, what you say. You figure out the narrative, you figure out what's happening, and you place a bet based on what you think. That's when you start to do well. If you're constantly trying to offload your liability on other people, if you're saying, my strategy lost today. His trade idea just didn't work out. You're offloading it into strategy. You're offloading it on other people. You're offloading it somewhere else. If you can't take that risk into yourself, you can't actually bet in the market. You can't actually participate. Like you can't. You just can't do it. You have to be able to tolerate real risk, meaning that you should not be looking for trades that don't have any. You should be looking for risk, learning what it tastes like, what it feels like, how it hurts you, how it hurts others, why it happens, where it comes from, what is risk. You have to learn that. And it's something that takes a little time, but you can't deal with real risk until you can understand. And then you have to trust yourself enough to place a bet based on what you think. You cannot say, do what the charts say, because that means you're offloading all the risk liability onto your chart. And if you lose money, it's not your fault. The chart said it. And this is just a silly thing to think. This is trading. Your whole job is risk. Oh, yeah. Actually, Phil said something. I wanted to answer. It was, okay, so it's, do you think dollar weakness, this is Phil said, sorry. Do you think dollar weakness can become weakness in the ES eventually? Parentheses. Mostly it's driving up all assets near as I can see. But I keep reading some folks that think a breaking point is near. Okay, so the very first thing when you talk about the breaking point, burning platform management, the cliff, we are in a perpetual state of running towards and off of a cliff. That is normal. Not in the Soviet Union, like propaganda sense of normalizing. I mean, it is how markets work. There is always a breaking point. I don't think a market does anything without them. I think that a wise creator of a market makes breaking points because that's value. Death gives life meaning. Breaking points give markets meaning. So a perpetual state of breaking point is an important feature of markets doing things. No breaking point, no market. So when you talk about dollar weakness, there's two things that come to mind, and I'm going to make an assumption that the first one is that the dollar moving down here, like this. Okay, so here's what I think. If you have a dollar, I don't think of it this way. I think of a dollar like a glove. This is my art skill. And your hand is the value. When you go to put on the dollar, you put your value into. You can't hold value outside of a glove. You can take value and take it out of a glove, out of the dollar glove, and put it immediately into something else. You can do this. What it is that the value is a part of you. It's the thing of the dollar that you actually own and are liable for. It is you. So you take your value, you can put it into the dollar, you can take it out, you can put it into the ES, you could take it out and put it into Apple stocks. You could take it out and convert it back into a dollar, take those dollars over to the store and take it out and put it into 1,000 Xboxes. The point is then you're wearing Xboxes, which which consume the amount of value inside of them. So when I look at the dollar going down like this, what I think is there is a pile of gloves, this pile of gloves, let's say this is a big steaming pile of gloves, it's getting bigger. And so the inventory guy's going, oh my gosh, we have too many gloves, let's drop the price. I don't think of it as somebody stuffing the bid or the ask or filling positions so much as our inventory is going up, so price is going down. And the question that I ask is if you took the dollar and you pulled your hand out of the dollar and you threw the dollar glove on the pile, which drives that, where did you put it? Because you can't carry value around on its own. So where did you put it? So that's what I think. When you're pulling money out of actual dollar bills and you're taking that and you're putting it into something, where did you put it? What glove did you put it into? So I think that when you see the dollar go down like that, especially when it moves aggressively, what you're seeing is money going from the dollar into, and then I just leave it there. So that's when you hear me say, like, I posted this sometimes, it's probably confusing, is when I see this, I say value into, and then I leave it there. And then I take this value into concept and I keep it in my head, and then I look around the market. It's like, into what? And so if you come over to equities and you said to yourself, well, is there value into? Well, you could say, well, they're taking position. Could be bulls. It could be bears. It could be positioning. And then I make assumptions about that. I say I can see market moving. So that's the first thing, is that we're seeing the dollar decline, and I think it's value into. They're pulling off that glove, making the pile bigger so the price goes down, and then value out of it. On the other side, really quick about that, when this pile that we were talking about, this big old pile here, when they see that you're going to want dollars, they start driving up the price before before you want the dollars, not during, before. So if there's some event here, prices will rise up into it. So they need that price change, this little price tag, before the event, not after and not during, before. And that's a big deal. It is a huge distinction. So if you're sitting here looking and you're going, oh my gosh, a bunch of people are going to dump their longs, then the dollar would shoot up to try and to make that glove as expensive as possible, so that when you go to get it, you lose as much value as possible, or you give them as much value as possible for the glove. And so if we look over here at this market and you know we saw this move up and these bears got liquidated, if the bulls were going to dump their position, they were going to convert from stocks into dollars, because that's what happens when you cover, then we would see the dollar shoot up before they exited, because the market's smart and it knows it's coming. And so they want to price out their inventory as advantageous as possible. And so seeing this shoot down tells me that the bulls haven't dumped yet. They're not doing that. You must go from like a stock into the dollar and then invest in something else. I mean, unless you do that really quickly, I think most people take profits and they sit on it for a day or two while that they're whatever, and those get reported, and then they'll invest in something later. So what I see this moving down tells me that people are moving cash into something, and I'm pretty sure I know where. It's equities. But you know, we can see some moves up in oil and the dollar, and I've been noticing that. So it could be that there's people moving money into these investments. Maybe they're going and getting actual physical gold. I don't know. I think buying physical gold won't look the same on the exchange, because you'd be pulling money out of your trading account into physical cash, which cannot be taken off like a glove. It's not going to work the same. So in my opinion, when you take out actual physical cash, it's not sitting in your trading account. It looks like you took the value out. It's almost like you're walking around with your hand out. You're not really, but I think that's how it looks to the market, because we can't track it. So it looks like people were going into some of these things here. But as far as I could tell, gold and oil were both moving before the dollar got moving. So I don't think that is really the culprit there. I think that the money is moving into, and I think they're looking at equity positions. Another thing that you might want to keep track of is if you penned an order. Here's a question you should probably answer for yourself. If you penned an order, are you in a position? In other words, if you penned a bunch of orders, does it look like your account balance just went to zero? Meaning, does that get reported and impact the way that they would price out the dollar? Would they go, oh my gosh, all that money's gone? But really it's just penned it as orders on the book. Does that work? Is that how that they do that? It's a question you might want to ask. Quiz your broker, see if they even know. So right now, that was the other thing is the inflation concept, which is that we have 12% of our currency was printed in that 2.8 billion or trillion, $2.8 trillion. We inflated our currency, and this is, I think, the way that prices in the stock market do not function with respect to inflation the way that everybody seems to think it does. I think people think that if you inflate a currency, stocks just tank, and I think that's just silly. It just doesn't. It's not how the reality works. Stocks are not priced out that way. At least they're not anymore. Maybe they were at some point. I think that the way it works is that you have, over the course of some time period, and I think it's a month, we basically say how much money do people make in a month, and we'll just say $5,000. I know that most people probably don't make this much. $5,000 in a month. If I inflate that currency, sorry, let's not talk. Then we say that there's a stock that costs half of that month's work at it's at $2,500. Now, why would you do this? Why would you make this comparison? And this is the mistake that I think people make. They say, well, it's half of your monthly income. And it's no, it's that 100% of the average person's working power, their capital working power, this is priced to 50% of the average human being's money's working power. It is not priced to 50% of their income. It is priced to half of their working power. Half. Got that? Half. So if I inflate the currency, your new income might be $6,000 to make the same amount of working power. So while a lot of people are still making $5,000, they need to make $6,000 to have an equal amount of working power. We'll just say, I'm not doing the math, but after inflation, this is equal to that, right? Therefore, this $2,500 stock needs to go up to $3,000 to be half the same amount of working power. Stocks are priced to a percentage of the average working power of the individuals in the economy which the company works. So if you inflate a currency, how much does that stock cost using the currency? And it has to do with the working power of the people. And so the stock will go up. And so a person making $5,000 a month is going to look at a $3,000 stock and say, I can't afford that. And so that looks like this. Your stock price goes like this. And you, oh my goodness. Well, if these people don't pick up this price, then suddenly the market says there's no volume here. People don't think the company's worth half their working power. So if it comes back down to 2,500, you might think that's priced out the same, but after inflation, 2,500 is now, pull out the calculator here. Whoops. So 6,000 divided by 2,500. It's not this. It's not half anymore. It's less than half. So I did that totally wrong. I'm going to do that again because I want the right number. I just said the outcome I knew was coming. There we go. 41%. So we lost 9% of your value. 9%. Think about this. Are you ready? Are you really thinking? If you go out with your $5,000, what do you spend money on? Food, an Apple Watch, and gas. Your currency just got inflated. You now cannot afford all three. Which one do you cut? The one you don't need. So why does the stock slide 9% of its actual value? It's because the working power of the same income before inflation can't afford the watch. So it gets cut. So the Apple Watch price needs to come down. What amount? Well, 9% probably, or at least somewhere around there. So now the Apple Watch costs less. So the stock looks like it's priced the same. It is not. It is 41% of the average person's working power because after inflation, they couldn't do the same amount of work and they didn't get the pay raise they needed to keep up with inflation. That's why stocks shoot up after inflation. That's why the market looks like this. These are priced to working power. And if you didn't notice, Trump went out and increased the amount of money that everybody had for a little bit. And he is trying to make sure everybody has the same amount, if not more money. So their working power has actually increased temporarily, of course, but it's increased. And now we have this, it's pricing out do you see how this is working? Why it's going up? He increased the amount of money people have, the working power or the inflation is driving prices up first. And we always see this. when you have hyperinflation, the first thing that happens is a launch up. It goes and then it crashes. You always see everything shoot up first as the market reprices in the working power cost against the average citizen in the economy, not the dollar. That's how inflation works. It's this comparison. So if you're making the mistake and you're saying that Apple right now is like $380 per share, and you compare that to the average income of like, I don't even know, we'll just go with 5,000 again. The average income of 5,000, you might make the mistake that this is what matters. But what they're trying to do is say the average working power. And then after the inflation, you need to compare to the working power, not to the income. Otherwise, you get messed up and you don't understand how the market reacts to inflation. And then you're all backwards and you shorted when you should have went long or whatever. So that's when you say that when the dollar's going down, I'm going to guess you mean one of those two things. Those are my opinions on those two things, since it's 11:30 and the market's churning a range, and there's not much else to do. Okay, so thoughts on gold? Okay, so there was a moment there when Trump announced he was going to be printing currency. And I thought about what that was going to happen with inflation and how it was going to play out. He did it wrong. To be honest with you, I mean, I think he had good intentions. I really do. I think Trump was trying to do the right thing. I think he was absolutely on the right path, but I'm not sure that. I think there was a better way to deal with the whole situation. Nonetheless, this is not political. That's just my opinion. So when he said he was going to inflate the currency to such a degree, I legitimately started considering buying physical gold. All I could think about was the last currency turnover was Germany hyperinflated their currency, and then they switched over to whatever they have now. And then I think the euro showed up after, or maybe the euro showed up as a result. I don't know. They hyperinflated their currency. And I was sitting here thinking, oh my gosh, are we going to hyperinflate our currency? And I don't know. Maybe we do. Maybe we just keep on going. I think that when we print currency, and we talked about this already, which is how debt works in terms of countries, and why that the United States can tolerate so much debt is because we use it as leverage over other countries. So when he said he was going to print money and give everybody checks and stuff, I thought about buying gold, because I thought, well, if we hyperinflate the currency, I would rather have gold, because if the US dollar becomes worthless, for a little while, I legitimately thought about that. I went and actually found some dealers, and I considered it for a little while. I didn't. I think it would have been a good investment, because I think a lot of people were buying gold. But I think that pretty much everybody 50 years old or older makes a fundamental error about analyzing markets. They think that we still have the same market we had, and we don't. We do not have a market anything like a market before 2008. We have 5 or 6 major institutions who control the debt world. It is not necessarily a free market anymore. We don't have floor traders screaming at each other. We don't have that whole situation anymore. The debt market is essentially rigged. It's fixed by a couple of institutions who obviously don't collude, but they definitely do everything but physically talk. The other thing is we have electronics that allow instantaneous execution. We no longer have the matriculation problem that causes crashes. We fixed that after the 2008 hack, when somebody realized they could just pen a billion orders and the market would break. That was part of the reason markets crashed, is because orders took time to get from you through the market. We don't have that anymore. You cannot stall a market. It is almost instantaneous pricing in of events. We don't have this matriculation problem anymore. That's not a thing. We have unlimited debt where the institutions and we can handle all the flow of cash and it's instant. We don't have the same machine that we had before. The things that crashed a market don't crash a market anymore. The things that broke a market don't break a market. The things that manipulated a market don't manipulate a market. We have just a different world. We've shifted from this whole idea that debt, when I think it was Reagan, when Reagan unhooked the US dollar from gold and he moved it over to the debt market. We don't have a gold-backed currency. It's a debt-backed currency. Our currency is basically built on the military. And the military is built on debt. It's debt. So as long as our military is strong and as long as people continue to want US dollars and people continue to spend their money, there is no ceiling. We got rid of that whole idea of a ceiling. So when it comes to the gold, I think people are buying gold as a currency, not as it really is a whole new world. People are buying gold not as an investment, as a currency. And I think they're wrong. I think they're going to make money. It's going to look good, but I think they're wrong. I think what's going to happen is that the gold investment is not taking into account the way that the markets work now. In fact, I'll bet there are not a lot of people under 30 or 40 who own much gold at all. I think the buying gold as a safety is a philosophy of generations who remember markets that were different machines. And I don't think that the market's going to break. And I think that's what's going to break most traders, is that they are remembering a market that is wholly different than the one we have now. And so as they go and pick up physical gold, it's going to be a good trade. I think it's a great trade. But in terms of the economy, I don't think it's a sensible thing to really do right now. I don't think inflating our currency. Well, yeah, actually, John just said Bitcoin. And I think when the pandemic hit, everybody forgot what a Bitcoin was. The world forgot about Bitcoin for a while. We all just looked away from it. Do you remember before the pandemic, Bitcoin was something we watched? Do you remember when it shot up to 10,000 and then down to 3,000 and then up to 10,000 and people are making and losing everything and it's nuts? You remember that? Then the pandemic hit and then we were all just too busy for Bitcoin. I think we're just too busy for Bitcoin. And then I think there was this big stunt on Twitter, I think, to get people to remember Bitcoin. I think there was a big, huge play here with the whole Twitter thing, hacking Twitter. I think there was some somebody gutsy. I don't think it had anything to do with stealing money. I think that what they wanted to do was to say, we can hack Twitter and you send us Bitcoin and they can't catch us. That's how safe Bitcoin is. That's the play. They wanted to reestablish that Bitcoin could even let a criminal get away hacking Twitter. That's how anonymous it is. That was the goal. That is the goal. If nobody goes to prison, this is a big, big, big problem, because it means that Bitcoin is that secure. And the NSA is supposed to be doing their best job to try and hack in anyone who doesn't, hide their trail, and they know who has what and what has who and stuff. And it's like, well, is the court going to pull that data and let everybody know that the NSA is tracking all the Bitcoin sales and that it's not actually secure unless you work really hard to keep yourself anonymous? I don't think so. Why would the NSA do that? It'd be like a national security threat. We want a currency that people can fall back to, that easily converts back to the dollar instead of into gold, which it's not nearly as easy to convert back into a dollar once you have a brick of gold. I think that the financial world would prefer Bitcoin be the new gold, not the new dollar. So I think that this whole Twitter hack was an attempt to reestablish the absolute anonymity of Bitcoin. Nobody's going to get in trouble because Bitcoin is so anonymous. And the NSA is not going to rat us out, because I think it's in the United States' best interest to show people a better option than gold. So I think right now that what people are neglecting is that even though Bitcoin has not made it quite mainstream, I think it is the new gold. It is the new safe haven for quick conversion into something that's sort of like holding physical gold. Yeah, Alex, and I think that was the goal. It was the point that you could anonymously trade. In other words, it works like cash. Bitcoin is like cash. If I want to, or it works like gold. If I steal gold from you and I melt that gold down, it can't be traced. It's mine, it's cash. And I think that was the goal. It was to establish it's just like, it's not that secure. I mean, it is secure, but it's not like, unless you really go out of your way to hide what you're doing with Bitcoin, you're not hiding what you do with Bitcoin. It's known. You make one mistake and your whole Bitcoin wallet is exposed, and it can be tracked, the purchases that you make. You're buying illegal things across seas. Well, you better work really hard, because if you don't, the government will know. And I don't think that I think the government right now is doing similar to what they did with pirating. Do you remember back when everybody was pirating everything? LimeWire, what was it? Napster. That was where you get on and just download all the music for free, and they're like, pirating is so bad, it's so wrong. And the NSA went around and they collected data on everyone, and they did nothing. And it was really suspicious. Do you guys remember this? Because everybody was doing it, and it was like, well, so you're going to give me a $250,000 fine for stealing a song, but you're giving nobody fines. And I think the NSA was basically saying, we'd rather fix the problem. And I think they're doing the same thing with Bitcoin. They're tracking everything everybody does, and they don't want to scare you by giving everyone a fee. So they're just watching. No, they can't deplete your wallet. They know what you're doing. The point is that you can do things like buy drugs from another country that sells a drug you need. And you can do that using Bitcoin. But if you use the dollar and you try to use your debit account, you'll get flagged as purchasing illegal drugs. You can buy illegal drugs with Bitcoin, and you could get in trouble for doing it if the government was able to flag you somehow. And the thing they're not saying is that they can, just like your debit card, if you don't work really hard to hide your wallet, your transaction history. It's not that they'll take your money. It's your transaction history. They want to know what you're doing. And then what they're doing is just collecting data. And they're not taking people to court. I haven't heard them saying, oh, you bought 10 pills from 10 different times, we're fining you $100,000 for purchasing illegal drugs across borders. They're not doing that. Because I think they're saying, here's what people are doing. How do we take advantage of this? How do we fix the problem? So they're tracking everything everybody does, and they're not trying to scare people. And I also think it would be a national security problem, because if we get rid of Bitcoin, a lot of money is going to scramble. People think they're safe they're like, this is my VPN. Like, VPNs are safe. They're not, by the way. Like, a government can't know everything you're doing on a VPN. They can, by the way. That's silly. All the little rumors that went around about governments. Do you remember when the government came out and said, the government's demanding Apple make a backdoor into their phones so they can get into them? And I was like, they can get into them. This is all theater, security theater. And Apple said, absolutely not. But then at the same time, Apple came out and said, if anybody can hack my phone without touching it, because it's really easy to do if you can touch it, but without touching, and I'm like, wait, so an idiot from the street can hack into an Apple phone if they can plug in a thing, but the government can't hack into a phone? Are you stupid? Governments do this all the time. They let us know that, so I think there's probably plays where the government comes out and says, we want your transaction history because we need to know what you're doing because we can't see it. And the people say, no, you can't have it. And the government says, and they throw their arms on the temper tantrum, but it's all just theater. They know what you're doing. They know your purchases, and they're going to fix it. Or not, depending on what's better for national security. That's what they're going to do. Oh, John says some thoughts from the deficit myth. He quotes, when a country issues its own fiat currency and only borrows in its own currency, that country has attained monetary sovereignty. Oh, that's interesting. Sovereignty. Well, the United States definitely does that, and we loan it out. And he says countries with monetary sovereignty then don't have to manage their budget as a household would. Yeah, that makes perfect sense to me. So I think that Bitcoin is something that we should keep our eyes on, because I think the play is to get Bitcoin to be the new safe haven, like gold, to run to instead of actually physically taking your money out of the market and buying a brick of gold, which is better. Gold, human beings love gold. We have been in a romantic relationship with gold for tens of thousands of years for whatever reason. We've been in such a romantic relationship with gold for tens of thousands. It's so strong that there's all these conspiracy theories that human beings were made to mine gold. We just love it for no good reason. And there is a good reason for it. But we love gold. Gold will always be valuable. Just innately, people just love gold. So it will always be a valuable thing. You have a brick of gold in any country in the world at any point in time, a brick of gold that get you what you want. It always will have value. And I think the market probably doesn't want people to do that because it pulls money off the table. It puts you in an independent state where that you're not part of the market. So, yeah. Okay. John has further quote. Says that's why MMT sometimes describe the Fed as the scorekeeper for the dollar. The scorekeeper can't run out of points. Scorekeeper. Okay, so let's take a look at what's been happening while I've been rambling on about these ideas. So nothing. You can see that what's been going on here is that velocity is slowly making its way down to zero. And we have two hours and 15 minutes left about here, right? So as this makes its way, we're churning our way down through velocity to get to zero. Another thing that's happening is, look at this, we're at 45%. So you can kind of see this accelerates up, but maybe like here we get to like 50, maybe 55, somewhere in there, 50, 55% of tension. And remember, tension is negative because it's pushing, there's the force that got us there and the counter tension, and that's why it's negative when it's above. Negative, I think we get to like negative 50. If there were some pushes, we could see, sorry. Thank you. I always forget to do that. I don't know why. So we could see this move up. This is churning down to zero. We could see this get up to here like negative 50% or so. So, we bunched up here. We're getting clearly the wedge pricing shape is a result of positioning happening on both sides over and over. We didn't dip down. We didn't get a move lower. We didn't stop out this position. It's moving back up. We are now pressuring these bearish positions. The bulls, I think it's going to move up now. I think this is moving up. I think we were very close to dipping down because nothing happened, but then nothing happened. And so as this pushes up here, 65, as we push up through this level here, I'll mark it on the ES so that just grab it right out here. Right there. Okay, remember this was I'm marking this because this was the first buy position. It was unstructured right here. Decay went negative. It took a while, and then sellers decided that negative, they finally reacted to that, and it did take a while. And that's the first bearish position that showed up today, and that's why it's marked. And you see the bears have been trying to take advantage of that. I thought because we'd be pushing down, it just did not happen. And now we're back to pressuring this position. This has held together, which is the bullish position. So we got them. I think this market's just got its mind to push this up. And liquidate these bears into the close. I think this is where we're headed. I wanted to see a dip down. I don't have a position on this. If this had broken down lower, I would have been looking for something to try and place a bet on, because I don't think at any point today that the bulls lost control of the market. I just think the conflict was weak. We had a tooth, which is, the bullish position, then it got pressured, then we got decay here, and then the bears here. But because, if you remember, I just want to reestablish, if you remember, because tension was rising essentially without liquidating the counterparty, which is the bears, why do the work? And I was thinking we'd dip down and wipe out these guys and then move up. That's what I was expecting. That's what I was going to position. I didn't get that. It's okay. I know what's going on. That's all that matters to me. I don't like to be lost. That drives me nuts more than anything else. So these bulls didn't get liquidated, which I think is just a sign of strength. It's a sign that it's letting us know the institutions have showed up. The bears are gutless. So essentially these bears are failing. Why are they failing? They had a chance. I'm literally sitting here going, go ahead and take out the bulls. I'm fine with that. It makes sense to me. And they did nothing. Nothing. Well, markets love to make you pay for your mistakes, and I think they just made a mistake. I think they absolutely should have pushed this down, maybe closed the gap or something, covered their positions. The bulls could have picked up something and driven this back up. I think the bears made a mistake. They didn't take advantage of an opportunity that was handed to them, and that is a successful stress test. If you remember, a stress test is when you hand the opponent the gun, they put it to your head, meaning they have all the control, they can absolutely destroy you, and they fail. So the controlling party, which is the bulls, you give up control, and your counterparty fails after they have control. So they can't pull the trigger. They're like, nah. Okay. In that point, you have beat them on a deeper level. And that's what happened. They should have done this. And now the market's drifted back up. It's pressuring these positions. And I say pressuring because it hasn't turned them upside down quite yet. So it's putting pressure on them. And I don't think they should be getting pressure right here. No, you guys should have shoved this down. I think the bulls are going to go awesome. Awesome. The risk reduction held. This held. It's up. They've continued to pump tension in just the strongest way. So all that's really needs to happen is to push this higher, pressure these positions right here, and right here. And when they unwind their position across the market, tension will accelerate and then slow down, and then that will be the end of that. That's where this is. And I think I was sitting here waiting for that breakdown. I thought we were going to see it break down, ruin everyone's day. Totally sensible thing to do. And the bears just didn't show up. Where were they? Now, remember, so here's something to keep in mind. I think that if you're an institution and you sell here and the market moves favorably for you, that shows your hand. It says you did it. But in order to exit a trade, to really make money, to extract the money they're after, you need to get it down and liquidate. You need to win. And winning means the opponent lost. And in this model, we don't track loss as being upside down. We track loss as we see you unwind through the acceleration of tension. So sure, they hit. They tried. We can see the bears tried, but they failed. They failed. They're going to get spanked. We're about to see this pop through the high. We're about to see tension accelerate. They failed. They should have pushed this down. They had everything lined up to do so, and they didn't. They failed. So the bulls who are here are likely motivated. They'll be able to put in a little bit of capital, do just a little bit of work, get this up a little bit higher, and then as the market starts to realize, or as the market eyes them, it'll start to grind and make its way up. We have our inversion level. Look at that. We just got a little retest on it. Here's our inversion level. So I'll rescale it so you can see that this correlates to the tick. Pretty straightforward. So I just mapped the tick intraday high onto the ES, and then I want to see it move over that, retest, and run, and that'll be inverted. So it looks to me like the bears have failed to pull the trigger, and I think they should be sweating bullets right now. And this is conceptually a good thing. We have the bears get wiped out this morning, and having them have this opportunity and fail is sort of like a narrative reset. This gives us something to look at. This gives us conflict. It gives us a reason for the market to move. So I think they should have moved this down. Now I think the market should move up. We have right here, you see this pivot? And this pivot, I'm marking on the decay chart now, not price. So this retested that. This is wide. And if we push up here, we'll get the short. So the wide short amount of time. We'll get a sample there. And then when that happens, that'll be the bearish, I can spell, risk reduction, decay retest, whichever one you want to say. And when they get there, what'll happen is then we'll have stops just above. And I think that's just going to be icing on the cake. If we get that, if we can get the decay retest show up, I think the bears have sort of showed us they were willing to hit, but not that they were willing to really play. And then they failed the stress test. So I don't think they're going to be picking up the decay retest. I anticipate the market does a little bit with the decay retest and then uses those stops to push higher as it pressures them into unwinding their position. That's what's looking like we have for this moving up. Of course, we need to look at the other scenario, which is if it moves down. I think this would be stupid. Just ridiculous. The bears completely fail to push the market down, and the bulls have a position. The market's doing the work. We pressure and it's just like, and the bulls just need to like wake up, like just watch. That's all. They don't have to do anything. And the market will, if that happened, I'd be like, that was absolutely dumb. Just dumb. Like a blunder by the bulls. Just absolute blunder. You had your stress test, you had positioning, you had a bag holder, you had everything you could want, a potential decay retest that could turn into liquidity to help things move quickly. That's ridiculous. If they failed to do this, they're morons. Just absolute morons. So I don't think that it should fail. If it does, I want to make that clear. I think that would be an absolute blunder by the bulls. It would show a massive weakness by the bulls, that they absolutely should have done that, and it would blow me away. I'd be like, are you kidding me? You guys just like handed over free money. Like just move up and you get free profits. The bears are willing to hand it to you. Just take it. Just say, thank you. That's all thank you. If it's too hard for you to do that, you have a problem. It's just so hard to come in here every day and take the money. It's like, are you serious? I would have a real qualm with that, a real issue with that. The bulls just being too tired to show up and accept the money. So yeah, so we're getting there. So I have it marked here. The highest position I think right here is this, pretty much the high of the day. The bears have. So that's, we can track these ones as well, but really it's just this one. And so if we moved up, sorry, that was a little aggressive. If we moved up, that they're going to be the ones who are unwinding. And the way you'll know is you see price is going to pop or sweep. It'll sweep like anywhere from 1 to 4 points. And a sweep is where you're looking at this and it says like 64 and then suddenly it says 67. Like it just skips almost. It's like, whoa. So you'll get a sweep and a tension accelerate. It'll accelerate. So you'll see it like curl. Right. And then it'll probably slow down. Those are the two things that'll tell you there it is. They just liquidated. And I think it should liquidate these bears for making this mistake right here. That was a big mistake by the bears. Not showing up, not taking the opportunity, not wiping out the bulls was a mistake, and the market's going to make them pay for messing up. It always does. I don't mean it always moves out. I mean, the market always makes you pay for your mistakes. Doesn't let you walk away from that kind of stuff. So here we go. So if you're in a position or something like that, you're going to be waiting for this to, I think we need to get over the high. So we need to get through the high and then see a pop. Not at the high. Not a push up to 68. Or see a move through the high and then a sweep. The chronology matters. We need to have that position upside down, grind against it, and then you see the pop. However that works out, then you see the pop and the acceleration in conjunction with that. And then you could say, there they are. They unwound their position. This is good. So this was tough, mostly because I was talking through the middle of this range section here. And I was anticipating a move down before a move up. So difficult to take advantage of right here. But I think that the situation's pretty clear. The bulls have control of the market. There was teeth. That's it. If I were to look back on this day and go over it, I would essentially say, okay, it was a day where there were some teeth into a decay retest and then the bulls wiped out the bears. So that's what I would call this at the end. That's how I would look at this if I were going to review from the future. So I'm expecting this to move from here up at least to... Let me get a better look at this. At least 32.70 by the close. 32.25 to really clinch it. I think the bears will hold on to 32.75. So I think at least today that a push from here up to 70 will pressure the highs here, but I think that these bears are going to be going, well, we're good up to around here. So I think we're going to see a pop through 70, and then the market's going to decide if it wants to keep going or not at that moment. I think most likely it'll keep going, but I think we're going to see at least 32.70 by the close, at least minimum, and then 32.75 through the highs, and then as we pop up through there, tension's probably going to be accelerating up, and if it does get to 75, we might be looking at 70, which, plus or minus 70 is about as high as I like to go. And then once we get up there, that means we could open at 32.80 tomorrow or something like that. It's possible, and then look at elasticity as a move back down, and then maybe we push down and close the gap from today, and it's like, oh, you guys and your tricks. So I think we could see that. So this is looking like as we continue to pressure these bears so that we could see elasticity tomorrow. And that's important because it means that these bears here, the best thing they could do is liquidate as high as possible, because if they let this move all the way up to 3,300, and then, I'm not saying that's gonna happen, but if we get to 3,300 tomorrow, then they could get elasticity from 3,300 and have a huge move back down if they can grab up elasticity and get this to relieve tomorrow. That could be a great trade for them. So it looks to me like the best case scenario is bears let it ride. I mean, not best case for these bears, these ones, but best case for bears tomorrow is to... So maybe if you're a real jerk, you'd call your bearish institutional buddy and tell him that you're 100% confident that it's going to crash, and then he would hold on for more. I don't know. Maybe that would help you sell tomorrow at a higher price. Maybe if you're a total jerk, you'd do that. I don't know how conniving they are amongst themselves. I think if they want to be jerks, they just don't talk to each other. That's what I would do. I just won't say anything while you make bad decisions and let you run your bad decisions to benefit me. Okay, so we got our second, right? So we got the first pivot here, there, and now we're getting the wide short. Here's the volume. So so what's happening here is we're getting that risk reduction setting up, and the stop will be just right above. There's not a lot of tolerance for the risk reduction. They're not going to like 5 points, 10 points up there. Like, it's just going to be on the other side there, and you'll see it when it cracks through it. It won't be one tick on the other side. So with a high here at 67, probably like 68, 68.50. Hey, I don't want that. And then you'll see it crack through there, and then you'll say, okay, there were the stops. There were the stops. That's the decay retest stops getting hit, and then it'll use those stops hopefully to grind it a little higher to pressure those bears, and then the market herself will start looking at their unwinding their position, and go, ooh, yeah, because really what the market sees is if this is time zero and it's moving along, where the market moves to has to do with the possible volume. So the market knows if you are going to get pressured out, and if you represent a large group of people, it will pressure you all out because it knows that there is a potential there for volume. It shoots for possible volume a lot, not actual volume. I think a lot of times the orders on the book are just nonsense anyway. So it's going, oh, okay, we could pressure these guys out. There's a bunch of volume there across the board. And why does it go for possible volume? Because possible volume tends to be higher than posted volume, and the market's after the fees, commission. It's a machine designed to go after volume because that's what makes the machine owners the most money. Risk-free money is the best, and they make billions. So that's what it does. Okay, so we're almost up there. I need this to update. The chart's taking forever to update. I need like an up bar here to let me know if the order's finished or not. See, I turn on the high-low. There we go. What? Oh, it's tracking that one. Gosh dang it. Fine. Fine. I'll just look. Okay, 60. So like 68.75. Okay, so it's slowing down, but it's not done yet. 9%. So as it moves up, it's slowing down. And these are buyers coming in. So this is buy orders showering in from the stock market, filling the backside of a potential sell order for institutions to consume. And they're going to use those orders to fill, and the risk reduction, these decay retests, puts a stop right above, and you'll see that. If you're Thinkorswim's charting isn't very good for seeing it. If you have another platform open that has real-time prices, you'd be able to see a lot better. And it'll push up and you'll see it pop through and you go, oh, there it was. So that'll be the stops getting hit from the risk reduction. You'll see them actually get triggered. And that's when you can say, I know they got stopped out. I saw it. I saw it happen with my own eyes. I'm going to scan some other charts here quick, just take a look at what's going on. So our dollar continues down, and I think, like I was saying before, I think that's money. People are taking their value out of the dollar and sticking it, and I think they're sticking it into equities. I don't think it's into gold or oil, because gold and oil were moving before the dollar was moving, and that doesn't add up. You should have been the dollar moving first. The dollar was moving second. I'm just waiting. There's not much to do here. You just have to sort of wait. Yeah, there's not much to do. Here's our inversion. You can see we got over that line, pushing up to the highs here. And this is good for anyone who's not familiar with why I call it an inversion. Basically, the stocks are ticking down, or they're not pushing new highs while this is pushing up. And I think of the amount of stocks upticks as cost. How much does it cost to move the index up? And what you want in a trend is you want, or a move that's paying essentially, is you want the index rising with lower costs, because good investments, right? You dump your money in the beginning. That's why it was like this. You know, it costs a lot in the beginning, and then you don't want to put more money in. You want the market to do the work, not you. So you put the money in, and then the business makes the money, the people do them, and the investor sits back. So the cost goes down, the amount of stocks it costs to move the market up goes down while the market goes up. And that means cash is, you know, it's doing the work a good investment should do. So we want to see that inversion happening. It looks like we're sort of getting there. Okay, there we go. We got this done. So we can plop this down right above here, right about there. So it looks like probably, I'm going to guess just over the high. I'm just going to guess that if you put money in here, your stop might be sitting at the high. Maybe just under it. I over the high. I'd say they lined up with 70, 32.70. Maybe a little bit higher, maybe a little lower. 30, maybe say 32.69. Stops will be sitting just above the daily high for that decay retest. Because you don't want to put it, I mean, it's a risk reduction, so you don't want to put your stops like way up there, but you know, over the high, you might as well. It's like 1 or 2 ticks. You might as well just stick your stops over the high. Okay, so we got that set up. You see the volume there is all done. It stopped showing up here. And we have our wide, so the wide test, and then the shorter amount of time, or the intraday section here. So we have our decay retest in place. So now this is a chance the bears could use to go ahead and hit. Your risk, the whole point of a risk reduction, when I think of risk reduction, I don't mean this particular setup, I mean a philosophy. And the philosophy is this. It is a position which has some event, some knowable, replicatable event, which can sort of guarantee you like a 2 to 3 point pop. And the idea here isn't, it's not to drive a whole move. The idea is to be able to get into a position that makes money really quickly so that you can start trying to do the things that institutions do with money. Like, for instance, if you were an institution and you sold the ES right now, your account balance would go up. Sorry, that's the TOS. Your account balance would go up $12,000 immediately because you sold, and so you gave the contract away, you get the cash. So you have $12,000. And so they'll take that $12,000 and they'll go like this. And they'll say, what kind of hedging could I do? Could I get myself into a position, maybe? So if you get into a risk reduction, you sell it and it pops things positive a few points. You could maybe get an okay bet here, and you put that $12,000 to work buying a couple options or something to try and get to maybe like a spread or something along those lines. So that's what they're going to try and do, is put that to work. Maybe we could go to 1 day of expiration, 15 points. So $500, you could buy a ton of those. So you sell to get that capital to start trying to do work to maybe get your side moving. So, I mean, how many contracts do you have to sell to get enough capital to actually make a difference in the market? I don't know. The whole point is that a risk reduction allows you a chance to get into a market, and that market pushes positive really quick and lets you, hopefully, probably automatically, get into some positions that can give you a potential edge to try and push the market right off the bat. And then if you do it right, you could keep that going, fill a few more contracts, keep it moving. And if it keeps going, you just keep doing what you're doing until you're in a winning position. And the ultimate goal is obviously always the positive spread, which costs you $0. Your risk equals 0, and your profit potential is infinity. So that's the goal I think a lot of institutions go for. But I think right now their risk is a little bit higher, but it reduces it a little bit because it'll push it positive for them, and they can start to get the ball rolling. But the cost of that is that we know their stop. But so it's like you get reduced risk, you get a little profit, but you have an exposed stop. We know where your stop is. We know where it's at. We know what has to be done to push you out. So if you can't make that happen, you are going to get stopped out for sure. There's no doubt in my mind. So this is the trade-off. And it's not a guarantee that it's going to work. It's just a little window there, an opportunity for it becoming a push. And so this is their little opportunity. They got a point or two out of it, maybe-ish. They probably maybe a move down 65, 60, yeah, 32, 64, 50 maybe. We get a little push down there from the risk reduction, could be all right. I'm not sure that I really think that the bears should be selling right now, though. So for new of you, the decay retest. So you need a retest and then some volume, but essentially you observe these when one, the party has no other options. So like decay is positive, velocity is also positive. So we can't see decay move up and flip from a negative to a positive number to generate liquidity. We can't see velocity move up, flip from a negative to positive to generate liquidity. So they don't have options when it comes to generating liquidity. This is their last play. And the second thing is we have seen, so you've already seen it, a willingness to play, or they they want to. And we have seen right here that they are willing to participate. So it's not that they're not playing. And we know they don't have other options. So that's why we're looking at this decay retest, is because they meet the qualifications. They obviously want to play, and they obviously don't have any other choices. So the decay retest becomes a viable thing to start tracking, so that we know when they have the opportunity, and it's right here. And we know that they do want to play, but the thing is they failed. So it's like, well, now are you going to try and shove this down? I mean, you guys are upside down. I don't think the Bulls should allow it. And I think the Bulls are in charge here, and I don't think the Bulls should allow it. I don't think the Bulls should be letting the Bears do this. I think that the Bulls need to stand up and say, all right, we'll put a little money in here and push that up. I think that's what needs to happen. I don't think the Bulls should let this happen. So we're getting our little pop down, or we got down 64. I think it's hit like 63. So our little risk reduction moved down. Okay, so they got their push. That's what happens. So they probably got some capital moved into their accounts. Now they're going to probably try and do some things to see if they can get control of at least the immediate prices. So I'll set this right here. So a lot of times you don't have to really look at anything. Just sit and watch this, and all of a sudden one whole side turns green and the other side turns red. It's like, you can kind of see it. So I think they'll probably fill some positions here. They'll do some positions in other places. And then you can know that that's what they're doing. I think now we get to see if the Bulls are going to let this happen. I don't think the Bulls should let this happen. That skid down was, they got their decay retest, they got their volume, they popped it down. And now I think the Bulls should say, all right, cool, and then run this up, hit the stop, sweep it. I mean, we only have an hour and a half left, so let's go. Let's get this done. Let's get this done. So we're back to 65, back through the high. So understanding the risk reduction, if you have questions about that, I hope that you can understand how these work. Like, the Bears have a very legitimate chance here. They could do this. They do. And the reason that I say I don't think it should happen isn't anything to do with the decay retest. It's to do with the narrative. The fact that the Bears absolutely had 3 positions, had the Bulls underwater, had a decay retest and some liquidity that they could have ran out, and they did nothing. They failed. They failed to take out controlling party when they absolutely had their finger on the trigger. They could have done it. They should have done it. It would have been great for them. It would have given me a price to buy in, and they did nothing. They failed. It's over. That is done. So them coming in here and saying, all right, well, we're going to pick up a decay retest, and now we're going to do it. I'm sitting here going, shut your mouth. You're not going to do it. You guys already screwed up. This is an opportunity to trick you into more positioning before we take you out. And that's it. It is a deceptive setup. They already lost on an emotional, deep level. They already didn't. They had the trigger and they didn't do it. They were like, I can't do it. And it's like, good. Give me your money now. And they're like, okay. So it's over. This is not going to work. But the decay retest does give the traders the opportunity to pop it down. They get some capital and they can use that to try. It is possible that they could flex their muscles and they could shove it down. You can never say it's never going to happen. I just don't think it makes sense. And I also think that the Bulls, after seeing this horrible failure, which only took like half a day to get to the point where we reestablished a pretty awesome narrative, I thought it was going to take longer. The Bulls are like, thank you. Thank you. I mean, how can we ever think you guys were supposed to push it down and screw us over? We were going to lose a little money, maybe have to position again, but you guys just blatantly stuck your head in the noose and jumped off the edge. Like, thank you. Thank you. So I don't think the Bulls really need another liquidity position. I think they're going to come in enthusiastically, gratefully. And as this moves up, we're just going to see bullishness. It's just going to, well, essentially, I anticipate this to just sort of make its way up there, and you're like, well, what was the signal? And it's like, it was the narrative was the signal. The fact that you understood what was going on told you that this was bulls trying to like get their foot in the door after they already screwed up majorly. Like, it's not gonna work, you dum-dums. It's not gonna work. This is going up. We're headed up. We're headed up. This should not go down. So again, if we're going to consider the other side, to be fair, if this does push down, let's say that they do get, you know, something to happen and they're able to push this all the way down and they push out this position here. What that says to me is not that the bears were successful. Okay, because the bears already failed. So this being successful has nothing to do with bears. It would have everything to do with the fact that the bulls just showed us their hand. They, on the longer term trend, don't care. It was weakness, they broke. This is a AAA setup, in my opinion. We let the bears stress test. We let the bears have everything. They did what they had to do. There was some concepts behind it. It could have worked. It would have been nice. There were some gaps. It was a lot of fun. And they failed. So the bulls have this excellent setup. All they have to do is show up a little bit, just a little bit right here. And then everything's set in stone, the check's in the mail. It's all done. So if that failed, just remember, it's not about bearish success. The bears would have won, but it would tell us that the bulls really suck. That's how it's like, what? Really? You really let that pass up? You had dominated them emotionally, physically, financially. Tension was all yours. Everything. And you just were too busy. Okay. I'm going to long some puts or something. That's what I would. Hopefully this makes sense. I'm hoping I'm not losing anybody and why I think this is going to move up and why I think it would be a blow to the major trend if it doesn't. Like, hopefully it makes sense. Like, the narrative here is pretty clear, I think, after we got down to the lows and it started to move up. I think it became pretty clear right here what was going on. Let's see, what could we get done in the last hour and a half? That's what I'm wondering now. We could. No, I don't think velocity. I mean, getting velocity down like this to sample would probably cost a new low for the day. I'm rolling the scenario over my head, what that would look like, what it would mean to me, how it would look on the numbers. I don't like it. I don't think it should happen. 20 points or 25 points out of the 1900 here. So, well, let's see. 25 times 20. I'm not going to. 500, and we need that out of 19. So getting that down to 1400. We'd have to lose 500 ticks off of this. If it did, if it pushed down and we had that at plus 1400 still on the advanced decline, that'd be interesting. Boy, that would be interesting. I might buy that. If that happened, I'd be looking at positioning for a move back up. I don't think it's going to happen though. I think the last hour and a half, the next event that's going to happen is we're going to get this velocity number sampling 20. This little dashed line. And for some reason, the algos like to react. So I think right now, once this chart updates, because it's 12:30, it's going to give us another little pop down, sample that. We're going to see an algorithmic response. And I think after that's done, if it sits and fiddles around with that for a half hour, it would only be 2 bars. That'd be a very aggressive move down for it to sample, and I don't think it's gonna sample. But if it did, that'd be pretty intense. Alex says market internals are pretty strong, but without a good pullback, bulls will get in half size or quarter size. It's moving down. I'm thinking, well, if this moves down, it would give me an opportunity. I wouldn't mind that because I didn't get anything. I was expecting the market to push out the lows. I didn't think that. I didn't think these bears were going to fail so miserably. So I have no problem with this moving down. I don't have any positions through here. I'm not in anything. So if this moved down and it was able to give us a sample, okay, there it is. So we got to 19. A lot of algorithms like to fire off right here. So that's pretty normal. But if it did get down to 0 and we're able to get something reasonable, I would think this would move. Yeah, if I would go in if it was lower. I'd need a sample. I'd need conditions to work out. Okay. Yeah, same page. That's good. I'm concerned though because I don't think that it's going to come down any lower. I think that that these bears already messed up, and there's a decay retest right here, and the market just needs to push up through there, and it would be able to pop, and everything would get rolling. I think it would be an absolute blunder by the bulls to let this move down. But I don't have a position on, so maybe not. Maybe the bulls need another position. Maybe people were thinking the same way I did. And so a move down actually would make some sense. I don't know. I didn't quite get what I wanted, but I see what's going on. So I'm just waiting. If I get a good opportunity, I might play that, depending on how it works out when we get there. But if we don't, I'd love to see the Bears get taken out. So that's what I think should happen. I think that should happen. I don't think we should be letting these Bears, giving them another chance. You know, we get this down here, and you know these positions are going to be looking at, oh, okay, well, you know, we're back in the green. Maybe they could put them back to work, do some more things, try and make them work. Just don't think they should be doing that. The Bulls shouldn't be letting this happen. They should be saying, yeah, let's go ahead and take those guys out. We got what we needed. Let's make it happen. We just wait. All right, give me just a minute. All right. Nothing. Still there. We still have an hour and a half, so there's time for a couple of different things to happen. When you can see see this moving down. So I mean, if just nothing happens, we could get closer, and then maybe if it waited till right before the close and then sat here and then dipped down, that could get this down closer, and then sample. I do, yeah, right there. That's the one I use for the dollar. The DXY. Or if that's the plan, you just sit here and wait while the velocity gets closer to zero until it gets there. And then the bulls could pick something up right before the close. Shenanigans is what that is.
Where's Hannah? Where's Hannah?
I think she's in a room.
Well, come look if he's in their room.
Is she not in a room?
Come look if he's in their room.
It's a she. Let's come look if she's in her room.
Let's go look if she's in there.
Nope. Yeah, Alex said it could clear all the longs before clearing the shorts and squeeze up, and that was the play earlier today. I think that the Bears had position and they were able to do it. All they had to do is to get this lower, and they could have cleared all those longs. Had time to set something up, and the Bulls could have run this higher, but then they just failed to do that. And the market is now back up and pressuring these positions. So it hasn't really. I mean, it's gone above them, but it hasn't really turned them upside down right now. So I think the Bears had that chance earlier, and they could do it again. I think it's a heck of a missed opportunity. The Bulls could make this happen into the close today, easy, no problem. A push up, get through that stop loss, get through the highs, and we would see the Bears unwind and into the close. It'd be great. Maybe that's just what I want. So I'm just waiting for the opportunity. I was anticipating earlier today that this would push down, and then I would get some opportunity down maybe in this area, and then a move back up. That's what I was anticipating that. Sure. This decay the decay retest right through here is doing. Got that first push, and now we're getting down. It's looking a little bit better and a little bit better. More than I was anticipating. I just think the Bulls should have run this out. If this does push down, I think that we're going to be looking at wipe out both sides. But I'll get an opportunity. I'm hoping to get an opportunity if we do move this down lower. If the velocity can get down to 0 or something like that, I think this would look like a pretty good spot to hop in for a move up back to the highs. I'm not sure exactly how aggressive down it would have to be. We could sit sideways. If the market wanted to do it quickly, it would be pretty aggressive. But we'll see. I have no position on this. I'm tracking the narrative. If I get an opportunity to place a bet, I'd like to. I think that the Bulls have control of the market. I don't think the Bulls have stepped aside. There's not like any indication to me that the Bulls are going to just move out of the way and let the Bears curl this down and take advantage of an elastic market. I don't see that. But I don't have any position on this, so I'm still waiting for an opportunity to potentially take advantage of it. We'll see. Hmm. We almost started to expand right there, but nope. You can see we had some contraction. See that? Sort of a hard thing to see with volume profiles, but contracts in, and we've just sort of been in this range here, finding all that volume. It's just hanging out. 62 back down under here. Is this gonna, are we gonna go for that? Are we gonna go for a bullish position? I'd be happy. I'd be happy. It would give me something to do. You know what I think a lot of people are doing? I think a lot of people are drawing a channel line right here. And when you get a channel that blows out, you know, sort of like this thing you can see. When you get a channel that blows out, it's not that it follows the channel here. It's, well, this is the pitchfork thing. Anyway, it doesn't matter. Is you go back to where the channel started. I think a lot of people are looking at this and they're saying, oh, okay, we blew out the top. Now this would be the target. And then we're moving along here. So the reason I say that is because I think that this is terribly obvious. Like if you just look at the chart, you almost can't help but to see a channel. And I think that's important because things that are terribly obvious rarely work, but the market likes to toy with them. So just thinking out loud here, if the market moved down even to here, I think a lot of people would be anticipating a move down to the start of the channel. And it could do this and still just totally screw everybody over. Like there's a lot of freedom and flexibility in there in terms of generating that liquidity. And when I say liquidity, I mean all the people who sell so that institutions can buy based on some idea they see. I think that's just like you can't help but to see that that channel. It's so easy to see, and I'm thinking a lot of people are looking at that. I don't think it's going to happen. You could get a 3260 call for 1575 right now. should put you at 75.50. So the 60 up to the 32.75, which is here. So if you picked up an option right now, call option with 1 day, so through tomorrow, you'd be betting on a move like that, and then you could sell against that, and you'd have positive spread. That's probably the best you could do right now is to do that. It'd put 15 points on the table. It bets on a move up through, is that just basically a bet to move up through the highs. Interesting. It's just the patience phase. There's not much to do here. You just have to wait. We sort of figured out the narrative. We figured out what's going on. We have the bears in a way that they should have. I think they should have driven a new low, and they didn't. And I'm taking that as a failure, and that the market shouldn't let those bears out. We shouldn't let these guys. We shouldn't let them get their money. We shouldn't see it move down. The bulls have some pretty good positions through here. And I think that failure by the bears should get converted into getting liquidated for not doing it. They didn't do what they should have done. But at the same time, the market's sort of tinkering with the idea, getting velocity down to 0. Maybe by the close, and we get a little sample there, and we potentially get a bullish sample into the close today before things move off, and then we don't have a push up till overnight. And that's a possibility. So I think the market shouldn't move. I don't like the idea of moving down and letting them have their money back. But if the market sits sideways here as we move closer to the close, this velocity number is going to naturally move a little bit closer, and then we could see some sort of dip into the close, pick something up, and then it moves up and pushes through the decay retest stops and gets things moving forward from there. Which means just sitting either way. There's a lot of just waiting. There's not much to be done here. If you had a position from the lows, if you picked up decay retest or the liquidity here, or you just didn't think the bears were going to do it, which I think the bears should have done it. I don't think it should have failed. The gameplay here is just to wait. There's not much to do. There's just not much to be done. We just got to wait. I think we're stuck between this idea and the idea of pushing out the bears. Both bearish concepts, but I think we're just sort of stuck between them. And that's causing us to just have to wait. There, that's prettier for some reason. So I think a move up. So I was thinking about modeling out tomorrow. Alex says, can you explain a bit why tension is up and green? Buy volume is higher than sell volume. It is up even though the ES hasn't moved since the open. Okay, so Yes, the tension is up. There's two ways you can look at this: the abstraction, or the part that's meaningful, which is why, like, what happened. And essentially, I think there were a lot of people who got stuck into bearish positions who got liquidated, and the bulls really enjoy to move up, and this is the result of that destruction. The other way you can look at this is we had velocity this morning at like 120, not quite 120, but somewhere up there. Is one of those really high numbers. And that means that all the momentum numbers are really sloshing up there and creating, essentially, we're operating from a very positive possibility space. So when you look at all the momentum numbers and you create a possibility space for all those numbers, that is essentially what's happening. We have this possibility space in front of us, all this area, and it's all bullish. There's just a lot of bullish possibility space in there because the momentum numbers. So there's this force coming in as a result of blowing out those bears, and that's why this is rising. So really, the thing is right now, looking at tomorrow is what's happening. I don't think the market's really trying to figure out what it's going to do next. I think there's maybe some nuance here, but for the most part, this is headed up. Whether we get another bullish sample or something in the close maybe is up for debate, but I think that the market's going to pop up higher, and I'll tell you why. When this closes, tension's probably, okay, so we're at 50, so it's probably going to be like 55%. Maybe even, if this really shot up, maybe even 60%. And so we're going to close here with this, and that means that the bears are going to say, hey, we could drive elasticity. We could burn off the high level of tension. And the bears might say, sure, yeah, burn it off. That'll give us a better price. That was actually something I was looking for today, was a better price. So then think to yourself, if you know that tomorrow you're going to be looking for a counter trend position, you know that that's going to be a big thing. You already know this is going to be on the list, the to-do list of things to try and make. You know that. So what's the best thing we could see between now and then for the bears? Higher prices. I mean, it's at 32.64. So if we got this to 32.80, which is kind of the tentatively, the highest place that I'm really looking for right now, we get to 32.80 tomorrow, then they could say, well, I'd rather get 32.80 and then drive this all the way back down to, I don't know, the low of today, 32.54. In the elastic move, it would be better for the bears to drive this up higher today into the close and into tomorrow, and then they could take care of elasticity. If the bears try to take over the market today, what's going to happen is they'll push down, but the bulls are not moving out of their way. So all pushes down are right now slated to get pushed back up. So pushing down is a risky bit for the bears to do. They haven't gotten elasticity. They're not free to do that without a lot of problems because the bulls have control of possibility space. It will get folded over. So I don't think the bears should push down. I think the bears should just move out of the way, cut the positions they got, get it to a higher price. If we get all the way up to 32.80, 32.90, sure. And then tomorrow, that elasticity could really bring in some returns for the bears if and only if the bulls move out of the way. If the bulls move, then the bears could absolutely get this down. Sure. So that could be a real big move. I think that's good. Now, what do the bulls want? Well, the bulls want to liquidate these positions. They'd love to see this, get higher. That makes them more money. So we have a situation where both parties, really the best thing for both parties is to get this higher. So what's the holdup? Well, the bulls might want to grab another position before it takes off because velocity is moving and it could happen. They could fill a whole nother position before things moved. And I think that's the holdup. It's not a matter of which direction this should go. That's pretty clear. It's a matter of when. And I think the bulls see a possible position they could grab onto before it goes further. And I think that's what's going on here. It's this, and that's it. I really think that's what the market is looking at. And maybe we get that, maybe we don't. So this kind of puts you in a pickle, which is kind of a good thing because you need that risk. If you're holding a position from down here or somewhere in this area, you might be sitting and going, oh, so is this going to come down and get that? I don't know. It could dive down somewhere near the close, give us a sample, and then move all the way back up, which would totally suck for a lot of people who are sitting here doing this. Or it could just be like, all right, well, let's move along. It didn't happen, and then we just don't get a sample into the close. Either way, it puts you under this sort of superposition where both of these simultaneously are true. And superposition is a frustrating place to be because you say, whenever you're in a superposition like this, you're saying, well, I could cover here, let's say, and take a couple points. And then if it comes down, I could refill and take some more. But that's not really the problem, is it? The problem is you're not trading narrative. And so personally, I think if you don't believe that the bears are going to lose, then you should dump your position and take your money. If you're concerned that this isn't playing the way you want, you should take your money. If you think that this set up in a way that's gonna move up, then you should hold, and it could pressure you, and it very well may. But the question is not about whether this is going to move down or move up. The question, when you're in a superposition like this with two realities that are almost equally probable, and so they're both essentially real, is when you're in that situation, the problem is you need a conviction to a narrative, and your narrative can't be wrong. If you're tracking silly ideas, then your narrative does not help you. I think that if your narrative is wrong, then most likely this is going to dip down, stop you out, and then run. That way we can put you in a remorseful state or regret, which is great because these make you highly predictable and you produce a lot of liquidity when you're in those states. So if your narrative is all ski-wampus and you're in a superposition, then you tend to just make the worst decision. So if you don't really know, or if you're not super confident with your ability to read narrative, or you think I'm dumb or something like that, cover, take the money. If you have money, take it. This is tough. I haven't done anything. I mean, if you've made some money, take the money. This was difficult. I was anticipating some things that I didn't get because I'm picky. I'll wait 2 or 3 days. I'll wait. I can wait. I can wait for a market to give me beautiful things. I don't need to take garbage. I can wait. I'm a really picky, snobby person when it comes to trading. I don't just do stuff. I say, you give me a beautiful trade and you do what I want, or I don't play. That's how I am. And if you don't act the way I want when I trade, I quit. I'm out. I'm not going to mess around with nonsense. I'm really picky about it. You need to be. So if you don't like the narrative, if you're concerned or you don't understand why, you should take the money. This was hard stuff. I don't think you should sit around believing me or trusting me, right? To the degree that you risk a lot. You should believe and trust me to the degree that you think that I'm a source for some information that will help you trade, and that the risk you should take is the risk of listening and trying. And you should listen to me, and you should learn this system. You absolutely should. It is 100% worth your time. But you shouldn't do it as a way to follow. You should do it as a way to do it on your own, to become an independent proprietor of good information, not trying to find somebody to give money to so they tell you what's going on because you're lazy. I refuse. My My price tag is higher. I require that you become a new person. I require that you try. So if you're not sure, you shouldn't hold. Even if you're right. If it moves up and you could have made a bunch of money, you shouldn't have held anyway. You didn't earn that narrative profit. You didn't earn it because you didn't get it. It's not going to do you any favors to make money off of a narrative that you don't understand or don't believe, because tomorrow you're going to make a stupid choice. You can't learn bad lessons. You have to learn them correctly. The lesson you must learn is to trust yourself. You need to believe that you're smart enough. You need to believe that you're capable. You need to believe that you can do this. That's the lesson you have to learn, and you can't fake it. This isn't a fake it till you make it. It's a lot of work. You actually have to show yourself that you can do it on a real level. A real level. You need to have success. You need to understand. You need to keep up. You need to be like, oh my gosh, I get it. You have to place bets on the narratives that you see. You have to take some risk. Your body will never believe you unless it's seen it actually work out. It just won't. This is hard stuff. This is very difficult. But once you get to the point where that you actually feel like you trust yourself, everything's different. Everything's different. All of a sudden you're enough. All of a sudden you're not lost. You're not flipping through Twitter trying to find the next person who has the secret that you were missing. You're not desperately combing over every indicator trying to find the one that solved the problem that you, the one that hurt you. You need to trust yourself. And then all that pain in your past, all those losses and the difficulties and the risks and the struggles and the things you gave up won't matter anymore. They don't need to heal. You don't need recompense. You're different now. And those things you cherish them. They matter to you. Your pain in your past teach you things that no one could ever teach you. The cost of learning to trade is so high that once you learn to do it, you will know it was too expensive. I don't believe anybody learns to trade and says, so glad that I did. It was cheap. It was easy. No problem. And if they do, they're lying to you. The real cost of trading is that you become a new person. One who doesn't get the right answers. One who doesn't comply with the system. One who doesn't obey. You have to become a person who can burden the risk on your own and become the kind of person who could lead. You have to be okay with bleeding as a cost. It's a very expensive thing to learn. It requires a big chunk of your soul and a huge piece of your brain. You will have actively gone through insanity before you get to the point where that you feel like you really know what's going on. But if you have a person to teach you, hopefully you don't have to. That's what I'm hoping. I don't know. I didn't have a teacher. I thought that all gurus were full of crap and it didn't make any sense and there was a conflict of interest, and so I hated them and I refused to listen. Looking back, I probably could have picked a less cynical approach, but it gave me a unique perspective. I wasn't biased by all of the common things that people do. I know them, but I didn't spend time studying or using them. I wanted to come up with my own thing. It's my curse, I guess. Anyway, hopefully you can get to the point where you trust yourself and that you understand what's going on without having to go through life-changing struggles that ruin you inside and out. And then you can say, no, I get it. I know what's going on. I understand. I understand how to operate in a world where there is no right answer. I understand how to fight somebody that is myself. I understand how to do these things that are paradoxical successfully. It's a hard thing to learn. I'm going to guess that there's some people who are significantly better at it than I am. Like, maybe all of you are. And I just have no talent for it. And I had to develop compensatory skills to just do it. I don't know. I think Brian, you say you're a regular guy. And I actually think that a regular guy tends to have an advantage over the people at the top. I know that doesn't sound right, but they don't have adversity to overcome. You do. The thing that concerns most of them is the size of their bonus. And they have all the data and the software they were taught. They had teachers. They don't have the adversity that motivates them. And so, in the end, I think that gives you a massive edge. You are absolutely capable of doing this. Everyone is. It's just hard. And the rule of thumb is pretty simple when it comes to, am I doing it right? The rule of thumb is this: it's hard. And that's what filters most people. They don't want it to be hard. They want it to be easy. They want to find the magical indicator that gives them an edge. So they look through the indicators and they find one. Everybody has it. The thing that the market asks of you is hard to give. You have to care. You have to empathize and understand and expose yourself in a way that's hard to do. And you can. You're absolutely intelligent enough to do it. It doesn't take a rocket scientist to do that. What it takes is somebody who's willing to suffer a little, which most people are not. The great filter is that nobody wants to suffer. Nobody wants to face the pain. Nobody wants to sit and watch the market. Nobody wants to stay up late. Nobody wants to work hard. They want the answers. I mean, that's the whole point of investing, right? Is to get passive income so you can sit on a beach somewhere. That's a lie. People who make great passive income probably work harder than the rest of us, way too hard, because that's how you get it, is by being an idiot and going way too far. It costs a lot, but the thing that it costs is hard to give. It's you. That's hard to give. You want to give your work or you want to give your money. And I don't want your work and I don't want your money. I want your time. Nobody wants to give their time. And that's, I think, the cost. And the market knows it. There's good tools out there. It's not that. There's some good tools. The absolute fundamental best tool is a simple moving average. It is a perfect average. The problem with it is it had a lot of lag. So I think you can use a simple moving average even successfully if you read it correctly. And the problem with that means you have to engage the market. You have to engage it socially, for reals. Okay, so we have some developments we need to look at. So this is dipping down. Now again, this is not giving me what I want. It's sort of pissing me off, to be honest with you. I don't have any positions, but it still irritates me. I love to get what I want. This is telling us the bulls are a pile of steaming turds, and it makes me mad, to be honest with you. This is ridiculous. These bears just cracked. We just opened up a big ol'... Okay, so let me rephrase that. These bears were terrible from the open. Now we know they're terrible. I mean, when it comes to playing, cards, which I have a deck of cards right here. Playing cards. You don't know what my cards are. And that means that they're in superposition as far as you're concerned. They could be both great and bad. This scenario led us to believe that the bulls had everything they needed to do great. And the thing they were missing was not money, was not capacity, was not signals. It was willpower. And they just showed us what they're made of. This is bad for the bulls. This is really bad for the bulls, I think. If we had this lean down a little bit, sorry, that was if you hover over that for too long, it shows you all the inputs and stuff. So if they had hovered around here and then moved this up, said that's fine. But pushing this down, and now we're going to be hitting those stops here. Ooh, this is, I don't know. This is frustrating to me. I like to get what I want. So maybe we close up the gap. Maybe we get some signals. Maybe things reboot. But I don't like not getting what I wanted, and I know what I wanted. I know the path that I saw that was set up. We're clearly not going there, but it's important to note what this is taking out right now. It is not just, I think, it's not just, this is really stressing out the bulls. These bears right here and here are going to be able to take advantage. Now, tension's going to tell us the story. So I have this opinion that if the market drops down like it's doing here, which is pretty aggressive, I don't think this should have happened. I think that's why it's so aggressive. That if it moves down, that the bulls are going to need to dump their position because that was stupid. I don't care what happens from here forward. So we're at 56. So this has already moved back up to here. At this point, we just saw weakness by the bulls. Not a weakness of structure or anything like that. Like, this is okay structurally. They're still in control of the market. We could still see bullishness, but conceptual. And I think ideas are significantly more powerful than any signals or data set. If you remember Inception, you put an idea in somebody's head. So I think the idea here is that the bulls let this happen. They let it happen. They're letting these bears make money in their face. The bulls were hitting. The bulls showed up. So this is dipping down. We're triggering these stops. So this is looking to me, actually this is looking to like open interest theft if we can get the volume here. If we can get the volume here. I'm going to zoom in a little bit. Okay, so open interest theft, because this is for you, Brian, because I know you're new. Open interest theft, OIT, OIT. Open interest theft is where that you essentially, you want a position, and if I'm an institution and I open up 1,000 contracts, brand new, backed by zero margin, so 100% equity, there's a problem because I will shoot the open interest up by 1,000. Plus I'll shoot up the market capital, so the MCAP, the market capital up by my open interest 1,000 times 12,000. It is a lot. The market will notice. So when it comes to market cap and open interest, institutions don't want to do this because it becomes blatantly obvious to everybody and it puts a target on their back. So we're not getting the trapped orders here. So really quick, it's not happening. So we need to see, the bar's got to turn red. But the whole point here is that you let's say it dips down and there's 10 here and then 100 here and 100 here and 500 here, something like that. You let the market sit and build up that open interest. Or you have one really nice position that builds up that 1,000. And then what you do is you stop all those people out and you take their trade. What's nice is that the open interest will stay flat. There will be a bump in the market cap, but it won't be this bump. It'll be whatever the margin was on that. So 50% margin, they'll see the market cap pop up there, but it won't be as significant. So it's like a mute. It mutes their position. So open interest theft is useful if you want to take an outright position. You don't want anyone to see you do it. You push the market down, hit the stops, and those stops get transferred to you. And you're like, okay, I can now secretly fill my position. That's the whole point of open interest theft. So the reason I was looking at this is because we have a decay retest here, right? We had one here, and this is the one I was tracking, and I thought we should move up. So you can see how the market reacted to this whole thing. And it reacted the way I reacted, which is like, that shouldn't have happened. And so it's like, just slid. Well, these guys here have stops. And that's, if you remember, that's one of the issues with a risk reduction is that, I can mark it here, maybe that's a little less noisy, is that everyone knows where your stops are. Let me move this one too. And that means that you could become the source of liquidity. It's more liquid down there. So pushing down this hits, we'd see the bars turn red and we see sell orders fill, and that those guys would become liquidity. And so when you hit stop losses, which is just outright stops that are sitting there, it's just open interest theft. If you like liquidated an institution and you were consuming their position, you're taking out a big fish, and that means that's bigger fished, is what I call that. It's a bigger fish came in, because there's always a bigger fish, and it's a form of open interest theft on a large scale. So I'll look for that in situations like this where the market's just diving, because I don't think the bears should have won this at all. I think the bulls, this isn't about the bears, this is all about the bulls. The bulls are showing us that they are too tired to come in here and take free money. They're just so, oh, it's so hard. It's just, oh, so difficult. And this is an attitude that can precede major trend changes. It is an attitude that traders cannot succumb to, and they are. We just saw it, and it makes me concerned for the major overall uptrend that we've been enjoying for a little while. This I'm too busy for money attitude. Anyway, so we moved down here, and that's what we triggered. We hit those stops, and so we could see some open interest liquidity. So where this position, this decay retest, was sort of I treat it like a little bit weaker of a position because of the way that it works. It could turn into legitimate liquidity by getting stopped out and provide the opportunity for institutions to come in and consume it by just stealing it. They're just transferring it to themselves. Okay, so here we are. This volume I'm associating that with this. So the stops got hit. You saw the sweep. You saw how aggressive this moved. And I think the aggressiveness had to do with the fact that, well, the condition we were in, we slid down. Now we're getting some trapped orders coming in. So the sell orders are showing up in the stock market. The buyers are going, okay, do you want this? And if they pick it up, they'll be able to conceal themselves by stealing some orders from these guys. And this is kind of the thing I was looking for earlier, but we didn't get it. And then the market moved up and pressured these people, gave a decay retest, which I thought would fall apart. It didn't. The bears held on. They hit. The bulls are like not doing great. So this open interest theft is looking like it could potentially be an okay spot, but the velocity is at 2. So while this open interest theft could be a good spot, I think this velocity could dip under and give us another move down. And looking over here at this, we still have the gaps a little ways off. We got the half gap. This is 1/2 the gap, that dashed line right there. So we've pushed into the gap. We got half gap. If we dipped down to there and velocity came in and gave us, there we go, and gave us a sample, we could maybe kill 2 birds with 1 stone right there. But I think what's happening is this right here is looking a little better. These guys stopped out. We saw the sweep. We're seeing the traps. This is an okay spot for the market to do that. The thing that puts me on the edge is that I really hate what just happened. I really do. I think that the market should have pushed up. I don't think it should have pushed down. But conflict is conflict. So we're going to ruin these guys' lives. And if this develops correctly, maybe we can get this velocity down under 2. All we need is for this to get to what, 16 to 4 days. We got close even to 1650, like 1650. Sorry. So if the advanced decline gets to like 1650, we'd be looking at a velocity sample. We could get some trapped orders and you just show up right there. And then we could see that pop up. It would be a great spot to get into. Liquidity theft at the low is an irritating thing to do because of this whole situation. We see this a lot. The liquidity theft. Okay, so the way this works, you have to understand it's looking for a pattern. And this can be tough. Pattern, and I gave it basically will repaint for about 2 bars because it's looking for a pattern. So you need to be flexible about that. It tends to be that if you get, if you have a bar or 2, it's not going to go away. But on the current bar or the one, I give it enough for 2 bars. The volume was there. It did meet the pattern, but it's gone now. It sort of got consumed by these buy orders who I think took over the bar, but it was there. I think this would be good, but yeah, I think that would be, I'd be happy right there if we got that, especially if this was like a deeper move, closed up the gap here. We got the trapped orders right into the low. It pops up. We see maybe a hit. Look at that tension. Ooh. Look at tension. You see that? Look at that. So I think these guys liquidated. At least a little right there. Look at that. They dumped. They dumped their position. Last half hour. Okay, so you could see that they got it to curl down. So those bulls, not these ones where the decay went positive to negative. There's the volume, people responding to the signal, positive to negative. Now there are 3 positions here, and this is what happened when we wiped out 3 positions by the, not 3, it was like 4 or 5 positions by the bears. So a little tiny curl down lets us know that at least one of them liquidated. Probably, I'm just gonna track this one. Probably them. Somebody dumped, unwound their position. We can see that footprint right there. Oh, the open interest theft. But this creates another problem. Oh no, it moved up. We only have a half hour, guys. Okay, the problem here that this creates is if these bulls failed and they got knocked out right here into these lows, the bears are going to potentially start going elasticity now, not later. And they might want to try and pick up some elasticity. So we could see maybe things move up a little bit or something like that into the close. And then tomorrow we see things move down as they try to burn off tension, taking that as like a nod to them to say you guys can go. But at any rate, we had a little bit of volume right there. It popped up, it disappeared intrabar. I know that's frustrating, but it was there, and I do think it was these people, and I do think they dumped right into that low, and I do think there is potential for this to pop up right here. But I would like to see velocity go under 0, and in 4 minutes, it'll probably pop down at least a little bit. So if this decided to run away, okay, so a lot of you already know this, and I need to explain this to Brian, who's listening. I feel like Brian represents a group of people who many of them are not talking. He just happened to mention it. As when you see velocity move towards 0, where that we generate liquidity, which is when traders see velocity go from like positive 10 to negative 10, they think that this chronology means sell. And when they see it go from negative 10 to positive, or positive anything, they think that means buy. They equate they equate changes from negative to positive to obvious buy and sell signals. Or essentially, when the momentum turned positive, you should buy, right? When the momentum turned negative, you should sell, right? Well, we can validate that. We can validate that by saying, looking at the volume. So we see the volume going green and red. It's looking for patterns, a footprint for that. So if velocity moves down here, that will generate that signal. Got it? Okay, that's not the thing I want to explain. As we move towards the liquidity, so T for towards, this equals the positioning. If bulls want to buy, then the market moves towards generating bullish liquidity. If bears want to sell, it moves towards generating bearish liquidity. So when this dipped down, the bulls said, I want to buy, and decay moved under, found the orders. It was because the bulls moved towards the market that the market moved towards the bulls. So you could think of this as bulls moving towards wanting to fill. So right here, you see how it popped up? You could think that as bulls moving away from the market. Oh, we don't want to fill anymore. So it moved aggressively towards, didn't generate it, at least here. I think we did generate a little bit here with this. We saw the volume there. Does that make sense? So you want to say, as it moves towards the liquidity, that means they're moving towards. And occasionally you'll see stuff, and I want to just show you really quick, just because this is important to understanding what I think is going on right here, if you're going to interpret this. So like right here, you can see this was moving towards bears. If it had ticked above and then generated some red bars down on the SPY, then the bears would have been there. But all of a sudden it was moving toward, bears wanted it, and then bears said, never mind, and it moved away from bears. And you can see whatever it was that they never mind, and obviously never mind. They didn't want that because it was going to screw them over. And there was no, it can't get to zero. So it wasn't moving towards a bullish position moving down because there was no sample there. So you had to look elsewhere to get liquidity. So then moving towards, it's moving towards the bears, getting a liquidity sample, and then it flattened out. So it moved away from the bears. They didn't want it anymore. And then it moved slowly towards until finally right here, it sampled them. So don't think, the cause of it moving towards them, I think of as the institutions wanting to fill. So then we move back to right here and you see what happened? We almost got a bullish liquidity and then it sort of leaned off. And it's like the bulls, why didn't they want it? Decay could come down and sample, velocity could sample, either way. A sample consists of, for liquidity, it's a cross plus the volume. And you can use this with any indicator at all. It doesn't matter. If you use the trapped orders indicator, you can line that up with any tool to track liquidity. I use momentum off the NYSE because it is the most popular. It represents the largest body of participants. So I think institutions use momentum, and I think they use various analysis, but essentially it comes down to, how do we make people take the wrong side of the trade? And you show them something they want to see. That's what you do. You say, you want this? And they say, yeah, I want that. And you fill an order and you filled to the backside of their position. They say, oh, great. Show that again. They show it again. And more people do it. And so they're getting people on the wrong side by showing them what they want to see. So I think it's inherent to the market that this works this way. Anyway, so we're moving down. You can see all of a sudden it moved towards that and then it cooled off. So we're sitting here looking at the bulls going, hey, what are you guys doing? They're almost there. They're almost there. Our gap is at 20. It's at 43. It's at about 43. This right here is yesterday's VoltiWap. VoltiWap stands for volatility and volume weighted average price. So it's similar to the VWAP, but it adds volatility in there as well. And so this is yesterday's, and it's just common to see it retest, those kinds of things. We're getting close, and the gap and the VoltiWap are sort of similar. The VoltiWap's a little closer. We're getting some, so these are the sell orders coming in from the stock market, the NYSE. They're coming in, they're triggering, they're seeing, obviously, I think you know what they're seeing. But the ones that I want are the ones that, so first we get this to cross from positive to negative. So it'd say velocity equals, it'll say -0 sometimes because I rounded it up. I should probably change that, but it'll say -0 when it's negative and I rounded it up. And then it'll say like -1. A bunch of traders will see -1 or their algorithms. They'll go, oh my gosh, it's -1. And then they go over to their stocks, maybe Apple. And they're like, yay, and they sell, I don't know, 100 shares. And those 100 shares are picked up and bundled up into a brand new SPY share, and that's given to an institution. And so this 100 shares in Apple was actually bundled up to create one SPY share, and that is liquidity. So once that velocity goes negative, we can assume that traders were seeing that. So we want to see the signal, then the volume. Not the other way around. Signal, then the volume. So first we see that go negative. This will capture intra-bar moves. This one doesn't because it was too complicated. Okay, so here we go. So once you get a green right here, it will stay. So the low, it'll move. So as you have a whole minute, the advanced decline could move up and down for a whole minute. And I didn't want to lose those signals. So it will capture all of it. All right, so we tagged the VoltiWap from yesterday. We just got our signal. We are getting a pulse of volume. See, that's 26 now. So the volume is surging. We're getting a pulse here. This is good. We're getting our liquidity. All right, let me just make sure. 29. Close it. I need more. I need more volume. I need volume. Where are my orders? See, the signal happened. The reason that it was showing is because the chart took a minute to load. The Thinkorswim sends out packets of data instead of streaming data. So you'll get these chunks. And so my chart was behind a little bit. So this volume was happening before this signal. I believe, yeah. So I can't correlate them. I can't say that the people saw velocity go over and they sold. I can't say that. It's not true. So we're at 48. We're under the VoltiWap. I am looking at the gap. We got a half hour left in the day. If we get this to, it could be, the gap's down there. You might as well take a look at it. I think a lot of people are looking at it. So I'm looking this. I need to see more. I thought that was that. It was just the chart hadn't loaded up. And you can check that by looking at this right here. This will tell you that this is not the time on your computer. This is the time of the last bar. So you can, it's 34. So they're on 34, 34. This is on 330. So this chart's like way behind. And this one's at 332. And this is sort of interesting because you can use that as a volatility measure. Their data starts lagging a bunch. The volatility comes in, and you can even go into the stats and you can see when it caps you out. So this is Thinkorswim's. You can see it caps right here. The data was coming through and it was apparently too much. My computer could handle like so much more. But according to the platform, it was too much. So that capping out is what's causing these lags in the charts. Now, these prices will always be correct. So I usually just look at this one because it's not going to line up a lot of times with these quotes will be accurate. This is why it irritates me because it's like you're getting the numbers in. Why can't you just put them on the chart? I know. I'm complaining. Okay, so this volume bar I'm associating with this now. It's in, it's going to stay. It's past like a bar or two. I think that was these people dumping positions. They got stopped out anyway. And then these guys dumped some too, and we can see that because it curled down there during that moment. So we're going, I know what happened, and I know where, and I know who it was. I can see right here that they were able to generate some liquidity, but we need more. Okay, here we go. We're getting down there. We're getting some 5%. This is the one I want. I'm gonna bring up my so 43. Did we get down to 43? Okay, so we're getting our signal. So this is the trapped orders coming in. This is the volume coming in. These are people who see this. They see this number and they're selling, and that's creating liquidity for the bulls. So right here. $22 minutes. So once this volume completes, and we are on 37, and the time on my computer is 38, so it's still keeping up pretty good. Waiting for that volume to finish up, and then that will complete the sample. Now, what's important about this is that this volume, this volume, I wish I could draw better. If I was a better drawer artist, this would be more awesome. But this is a silver platter, and here is the volume. It is being offered to the institution. They may choose if they would like to or not like to consume that liquidity. And in this case, liquidity means the orders have been generated. If they fill the order, there's no spike in open interest. They can essentially slide in, take advantage. They have somebody on the backside of the trade they know is uninformed. And so it's all just looks really great. They can choose Bryant from positive to negative plus the sell volume creates the liquidity. So that's this. That's why it's green, because we buy against sellers. So it's green here. So it went to negative, and now we're getting the green bars, and this is showing us that we generated the signal and people reacted to it. Real people, real algos, real people are reacting. We can see that here. So we know there's people who sold that idea, and now the institutional bulls can say, well, do we want this? And determining their intent, whether they want it or not, has to do with understanding the narrative of the day. If you can't figure out what they're doing, then you won't know what to anticipate with this. Furthermore, you won't know that this was not shocking. You won't really, if you don't understand that narrative, then seeing this move down, you might think, oh my gosh, the market's falling apart. Well, I see this and I go, well, I know why it shot down. It's because this was unexpected. With the conditions and stuff and the way things were working, this is kind of shocking. And that's what created that aggressive move down. You'd misunderstand that if you didn't read into the narrative and understand how it was structured and things. And so you see those big shoots down and you misinterpret them entirely. You don't know if it's going to be a shoot down that's going to bounce or it's going to keep going. And you think it means something about the quality of this signal. It's like, well, it's just the structure of the way the market was built. Okay, so we're really close. We got our 1%. Now we have a 4% here. We got under. So when this moves up, it's going to sample bears. This creates some problems because I think the bears are going to be thinking this is setting them up for elasticity. They're thinking, well, if the bulls screw this up, which they kind of did. Okay, they did. This got liquidated. They're going to say, oh, are they giving us the nod? I'm not sure that I'm reading that this way. The nod would have been that they gave up right here, like actively said, yeah, you can have it. This was like a blunder by the bulls. So I don't see this as a nod. So we're getting the liquidity here. This is going to tell us if they don't pick this up and hit this liquidity up higher, which it looks like they're hitting. Okay, I have a position at 48. I'm long right now. So if they don't hit this, if the bulls don't hit this, then I think the bears are going to read into this and say, the bulls just gave us the head nod. They just nodded to us. They just said, oh, this, you guys can have it. And then they're going to be looking at that. And so if this switchback could cause problems, if the bulls pick this up and they hit this back higher, then I think that the bears would be like, ah, crap. You know, we just got open interest theft. It wasn't that the bulls nodded here and failed and said, you guys can run this down. It was other things. So I think that the bulls should hit this back up. I think as we move back up, this will be the next thing to run into. And then I think if the market does what I think markets do best, is ruin everyone's day, this was just a drawn out version of taking out both sides. And I'm going to try and take advantage of the market moving up to take out both sides. I think moving down here gave me, it just took forever, the thing I wanted, which was a velocity test of 0. So popping this out the lows, hitting those guys, we see the open interest theft here. I waited a little bit. Why? Because this is happening. We got really close to closing the gap. Is close good enough? I don't know. We're gonna see what happens here. So my expectation is over the last couple of minutes, okay, so we're getting another pulse of volume here. Over the next couple minutes, we're gonna see this decay could come down and give me a velocity test. Worst case scenario, we see the velocity move down, get through, and then you have a case where that you have velocity under 0 and decay under 0, which means that a move down cannot find a bullish position. There's no more possibility for bullish liquidity. So that would create problems for the bulls. So their option would be a decay retest, probably something here. So then tomorrow decay would probably have to move down, maybe sample there or something else. So it gets complicated if it continues to move down for different reasons. So I'm anticipating this was leaning down to find that bullish liquidity. I think that that it's just ruining everybody's lives because that's what markets like to do. And I like that. I mean, for me, that's opportunity. Yeah. So that's where we're at. I'm sitting right in here at 32.48. Yeah. We got 15 minutes left. There is at the 50 bar. We always call it the 50, but it's at 3:50 Eastern. Yeah, 3:50 Eastern. There's a lot of times there's this like algorithm that shows up and goes. So that's something I'm just keeping in mind. I think it was Burger Analytics who pointed it out. So hopefully this narrative has made sense and you guys have been able to keep up. Does this make sense? Is this good? I mean, like, is this useful? Hopefully there's been a lot of concepts. I think you really have to get familiar with the concepts. Well, John, you're saying you're concerned with tension getting high, but that won't be till tomorrow. Tomorrow. I think the bears can look at elasticity tomorrow, not today. I know I'm being snotty to you about this, but I think they can wait till tomorrow. And I think that this curl down was open interest theft. I don't think it was a nod by the bulls to say, okay, bears, you can have it. I think this was complexity coming in, these guys getting taken out. It wasn't a nod saying you guys can have this tomorrow. Still think the best option is for this to shoot way up, take out the highs, retest the overnight highs, open up there, give the bears a chance to sell elasticity tomorrow from as high a possible price as they can get. And I still think that makes perfect sense for the bears. So selling right here is going to sell them short because this was too early. This was too early, and this was too early. All this stuff was out of context. So, okay. Yeah, and Brian, as long as you ask, I try to take the time to explain things. It gives me, there's a lot of filler time. So I think tomorrow that the elasticity is going to be the time to really watch this. The next event right in front of me here, the last couple minutes, is going to be this whole thing right here. If we see the bulls start to, they hit, which it looks like they're hitting, and we're getting this moving up, that we're going to see this get over 0. When we see that, that positive number, we could be looking at a bearish liquidity. But I don't think the bears should hit here. I think this looks like a ruin everyone's day on both sides kind of thing. Tomorrow is when the bears should hit. I think it would be not a waste of their time, but I think it would be too early to hit today. I think they'd be getting in too early. It'd be eager, the eager beavers or eager bears if they got in, because they don't have the nod. So that's where I'm at. So, okay, so let's get an idea about the scope of this trade. Now, when I say scope, I mean, what kind of thing is operating here? Is this like a multi-day trend? Is this an intraday analysis? What kind of thing? Well, I think that, just to be clear, we had some bullish positions, right? So you might think, oh, well, bullish positions. Okay, well, what does that mean? Well, I think that this was this whole thing has been a statement about the capacity of the bulls to control the trend. That today we blew out the bears and then we were trying to reestablish the conflict. And so the scope for me is this a representation of the bulls over this whole move up? Or is this just the natural outcome of some complicated intraday dealings? Like, which one is that? Because this is a big deal. if this represents the bulls overall, this is a bullish position that the bulls are going to be using to try and sustain this trend and see what they can get to happen, then that means that the scope of this trade is easily, up through to and through the highs. In terms of intraday stuff, we got these guys to dump here, and the bears came in from here. I still think the scope of this is up and push to a new high in terms of where this could potentially lead to. So I think with the scope here, we have a couple of things at play, but I do think it's a narrower scope. I think this whole thing played out. We dumped here, and now the idea the market's trying to deal with is to say, are we going to continue or are we all done? Okay, so we got up here. We're still -0. I haven't seen it come over here, but this is where we're going to be. This is the tough spot where we're going to be finding out if the bears are going to try and pick this up or not. If the bears think that the nod was approved, then they're going to come in and try and hit this. If the bears do not, then I think they will just step aside and say, all right, let's get elasticity tomorrow into the market. So this is the part where they stress me out, my least favorite part. So we've gotten down to here. We have a gap just down below. There it is. All right, so we got this here. And that's showing up at the 48 bar. We're at 47, so we need to see this pulse. It looks pretty good. I mean, when this volume's done, that'll be about it. Looks like they're going for the gap. All right, bears. I don't like what I'm seeing here. So they got it. The gap is done. Can't see it yet, but in a half a second, it's going to go brr. All right, the buy orders are about finished up here. Now, the question here is if these bears decided that this is some sort of nod. I see pushed up, they hit, they pushed up. We have the bulls hitting, and these bears are aggressively pushing against these bulls. That was an aggressive position. You could see that they immediately hit that down. In terms of tension, I don't see. Let's get an idea about where we're headed. I'm not gonna tolerate this forever. Okay, so that's our. Let's go ahead and mark that out. So this was the last bearish, or I think bearish position to be paying attention to here. Move up. Well, I don't think, Brian, I don't think it was crazy. I think the bulls had position. The bears failed. It moved up, and this should have pushed up. And I think this whole thing is somewhat shocking. This is working on a shock value. They're saying, hey, this shouldn't have happened. And so the market's taking this as weakness. Weakness. That says weakness on some level. This is working at some weakness on the bulls. They should have pushed this up. This is an issue. I see this liquidity down here. I think it was good liquidity. I don't think the bears should be hitting. I don't think that this move down is going to sustain. I don't think that they should have shoved this down this last push. I think they're jumping the gun and it's going to fold them over. Awesome. If you understand that, that's good. Well, okay, so what's happened here is the market at this point here, the market had established that it was clear that up is the best option. That's what happened. This move down was quite shocking because it made a statement about the bulls. They had stuff. So we had sort of the bears fail, the bulls fail. And now the market has dove down. And I think that the market is ruining the bullish position. And I think it's going to move back up and it's going to take out the bearish position. And that's what I think is going to happen. So this was shocking. We got open interest theft here. We got liquidity here. So when it comes to weakness, structurally, the bulls have shown some weakness today in that they didn't take the easy thing here. In terms of tension, no, they have not stepped out of the way. The bulls showed up and hit. The bulls impacted tension when they did, and the bears came in with a ton of aggression right here and are trying to hit the market down without the bulls' consent. I don't think this is going to end well for the bears. And I think that tomorrow the bears needed to look the bears should be looking at tomorrow for elasticity, and they're trying to get elasticity today, and that is the issue here. That's what I think they're doing. They're trying to get elasticity today when they should have been waiting for tomorrow. So I think the market's dipping down here and the bears are here, and that these bulls are they're getting pressured right now. The bears are doing it. So, it's not that they can't push this down. I just think that the best case scenario for the bears is to see this go up higher before they try and get the bearish liquidity. I think we should see it move up. We see something where the bulls actually don't hit, the bears come in and hit, and then they could run the elasticity. And I think they're doing it too early, is what I think. So we got a couple minutes into the close, and then the SPY closes. We'll have a few minutes after for the ES to poke around. I don't know why this got moved. I think I must have dragged it. But I think what's happening here is that this move down, which took out this position is being interpreted as weakness by the bulls. That the bears hit, because that's how I was looking at it. And then as we swept down and we see that come down, we see it give us some bullish liquidity. The bulls came in and hit, but then the bears just made another mistake. I think this was a mistake. I think that the bulls should hit and they should drive this back up, and they totally can. And the bears are hitting down low and they think that they won because of the sweep. I don't think this sweep is saying that the bears are winning. I think this is saying that the bulls had some struggles and now they have a position. So that's where I'm sitting on this. I think that tomorrow it makes more sense for the SPY to come, up here to take out this stuff, give the best possible position, and then we drive this down. But we'll see. Maybe we don't get that kind of thing, and that's the frustration the market presents us with. But if you want to support me, you go buy an indicator that over at the BaconTrading site. Otherwise, the best way was to tell me what you think. Give me your real thoughts. Go into the Discord, post some charts and say, here's what I see, here's what I think is going on. That's my favorite stuff because I take that into consideration when I think about what's going on in markets. Yeah, be active, be a useful trader, share your thoughts, learn. if I get something wrong or I miss something, call me out on it. Because I miss things. Even sitting and staring at the charts all day, I still miss things. Okay, so we got that. It dipped down. You can see that tension sort of flattened out here. Like this whole move down didn't it sort of flattened out. I think that these bulls hit. We got that second jab down, which looks like teeth, similar to this situation. And now what I want to see is this move up. I don't want to see this position holding any water. I think this was a bad position. I think it was a bad move, and I don't think they should have done it. And I think it should get turned over, which I would just love to see the market close at 54 because that would put that position upside down right into the close here. So at this point, so going into tomorrow, when you look at the market tomorrow, the first thing we're going to be looking at, the big thing is, are we going to get elasticity? Now, 51% is pretty good. It is pretty high. I mean, we can run elasticity off less than 51. We can get to about 70 before it becomes problematic. It can't get to 100%. So 70's right about that spot. And if we can get up to, if we can open the market, even if just up here, and then we get something, I think the best thing the market could do is to try and get the best possible prices for the bears before it happens. So I think a move up makes some sense here. But it's not. The bears, if the bears seem like they're pretty enthusiastic, though I think is misplaced, the bears could decide that they don't want to wait for that. The problem that the bears are having right now is that they needed something like this signal to have no hit, so price came down and went sideways, and for tension to not rise. And we got it hit here, and the bulls picked up some tension. It curled right after as well. So the problem that the bears are having is that they did not get approved to run elasticity. That's why I think they're jumping the gun, and that's why I think it's too early, this position right here. And it weighted up right up into the close, which is a huge pain, but that's what happens. I think this is a retail filter. They want to filter out people because a lot of people don't have the margin requirements or the stomach to hold into the overnight market. It just, a lot of people just dump at the close. And so, this kind of thing doesn't really bother me all that much. But I don't like trading overnight. I like my sleep. I want to go do other things. So that's where we are. I think the next thing is basically, are we going to get elasticity tomorrow, or are we going to get this just continuing up higher? Those are the questions that we have. And with the dive down today and seeing that these bears decided to get really aggressive out of place, we might be able to maybe use that position to get us up higher. So I'm not. Let's see. Miguel says, teeth related to the open interest theft. I'm confused about these two. Okay, yeah, this is a good one. So right here. So we had some positioning back here on Thursday, and then some more right here on Friday. I call this the root position. And then after the root position's over, it's taken off like this, that this is now secondary. Secondary positions tend to have a good entry and then put pressure on it. And I call them teeth because they look like teeth, shark teeth, and they hurt. So what ends up happening is that teeth can look like open interest theft, and it can also be open interest theft, but it has to do with the fact that this whole trade started way back here, and this is the root of the trade, and this is now a secondary position. So if there's an institution with a large position here, they're adding. And so if they add right here and the market dips down further and then comes back up, that's fine. there's not that like pressure of having your position upside down. They're just adding. So it tends to be that you get the low two scenario where you get your signal and then it dives down and then comes back up. That tends to be what happens. So I call that teeth. It feels like teeth. It's shaped like a shark tooth, and they're usually no fun. So that's what I mean by teeth. And the open interest theft can happen at the same time. Is totally possible. So that's what those are. Market closed. I have a position open. I don't know that I'm going to tolerate a ton of stuff over going through here. I just want to make some money. I think we picked up the narrative. I think I know what's going on here. I think I figured out what's happening, and I think I know where the market's going. I think this dip down is an opportunity that I can take advantage of, and I intend to. So the market can now try to tell me things and show me counter signals and high twos, double tops, and all sorts of things. But I think I know what's going on here. And I think the bears made a mistake. So tomorrow, this is what elasticity will look like. Or this is kind of, so it could look like that. But in order, so for anyone who's not familiar, to get an elastic market, you need to, one, have the controlling party fail to hit. They do nothing, and it's a nod. It's a very nuanced nod. They say, you guys can take it. Two, you have a counterparty, some counterparty liquidity. You're not going to see, you shouldn't see elasticity happen where the counterparty didn't pick up any liquidity. Like they didn't position. That's crazy. Because the person who's going to do all the work to get this going, in this case, would be the bears. So they need to first see this, then we get that. And then three, you need to see tension move. And it tends to be that elasticity will be pretty smooth looking. Now the goal will be to get this, for the bears, will be to get this down to zero. So they're sort of hoping to get it to zero and then lie to the bulls about it. The bulls are like, go ahead, take it down, bears, make some money. And the bears are going to go, okay. And then they want to get it to zero and then be like, just kidding, and shove it through zero and take out bullish control. So obviously the bulls know that, but there is some risk in letting this happen. But if it doesn't happen, the market will get to the point where it's so hot, it'll just flip around and reverse, and it could really damage the bullish trend. So you kind of want, trends are basically built like this. You move up, so things get too hot, you cool off. And in so doing, in cooling off, you stress test. And the stress test is allowing the counterparty control. And when the counterparty fails, you move up and it gets hot. And then you stress test. It's just, that's the way it sort of works. You do something aggressive, then you let the opponent have control. And if they fail to take control, they fail to win where they should have won, then you use that failure and you monetize it. You turn it into the next leg up. And that's what sets the second leg. So we have our first leg. We're seeing things where that we get stress tests, and I think the bears screwed up right here. And it's important that you understand that a stress test is not a move down. A stress test isn't an aggressive sweep. A stress test is where that you allow the counterparty structural control. You say, go ahead, and you let them try. And if they totally fail, you are 100% happy, because now that they're done and you can go, you buy in to your position and you get another leg up. If you don't feel pressure as the controlling party, if you don't feel like you're literally giving up control of the market, you did not stress test the market. You just acted like you did. Absolutely. I'm positive that if you were to get in a fight with somebody and you handed them a knife, and they didn't do anything with it, you just beat them. Psychologically, you already won. You will win that fight. You said, here's a knife, go for it. And they're like, oh, I don't know if I don't want to stab you or whatever. Like, I don't want to go that far. And you're like, fine. Bam, you could just beat the snot out of them because you won. You won psychologically. They admitted that they don't want to hurt you. And you won. And that's the game they're playing. You have to beat the other side on a psychological level. And in doing so, you trap in a whole bunch of their teammates, a whole bunch of bears, and then you monetize that failure by using all those bears to drive the second leg. Does the news matter? I don't know, maybe. I don't know, I think so. I think this comes down to it's a game that people play, and that's pretty much it. So, yeah, that's where I'm at. So we're in the phase where the market needs to stress test. So one important feature, if you're still listening, is when you stress test, you have to remember that the bears know that you're in control. They know. They know you're bigger. They know you have more money. They know that you're in a winning position. They know. So how do you convince them to participate? How do you convince somebody who knows that you will beat them to play knowing that you'll beat them? And this is one of those scenarios where the best strategy is one that your opponent, knows, and you still win. This is the best strategy out there. And I think that's why stress testing is so important. You get into these conflicts, you say, I'm going to destroy you. You give them the chance to beat you. If they don't, you win. And they know it. So that's how they need to believe that there's got to be good reason here. You can't just have like little things, it's not like, oh yeah, oh, I'm so scared. Are you going to trade now? Like, you have to actually give something up. And I think that this dive down, showing some weakness by the bulls, is both risking the bulls, but also encouraging those bears to participate. This morning was a little frustrating, and I think that this dive down actually meets that requirement. I think it was rough, and I think a lot of bears came in and picked it up. So I think we've accomplished that goal. Have we convinced a bunch of bears to come in and try and participate? And I think the answer is yes. And I think they made a mistake. So John says, the philosophy has helped me so much. Sounds so simple, but it really has helped me. Oh, to understand the deeper game in theory in the markets where charts can help you. Yeah, I think so, you just reflect on yourself and you say, why did that work on me? And then at some point you realize that that's the game you're playing. And if you want to play, you need to play that trick on others. And it's required that tricks are played. So I think I like the psychology because I think it gives us insight into market intentions and what they're doing and why things move. And I much prefer to know why things happen than anything else. For me, that's my favorite part. So, okay, so that's where we are. Everybody should be on the same page. We're going to be looking at elasticity tomorrow. We are not believing it's going to happen. I think it could happen, but it needs to follow the steps. If not, I think the bulls are just going to drive this up and take everybody out. If tension's just going to, keep going and we're not going to have a burn off day tomorrow, then I think that tomorrow is just going to be pushing up and taking out highs, and the bears are just going to be like, oh crap. Otherwise, if we get the right steps, we get the bulls moving, then the bears come in, that they could run some elasticity, and that could push this down quite a way. So, yeah, I'm glad. I'm glad we had some more people in here, some engagement. We had some interesting stuff going on. The market was complicated. It was difficult. It still is, and that's a good thing. You want the complexity. You want the difficulty. You want the risk, because that means there's money to be made. If it doesn't hurt, it's not worth anything. Otherwise, everybody would pick it up, you know? Okay, guys, I will post on Twitter what I do if I do anything else. Otherwise, see you guys.